Morning. So we'll continue um, like the financial statement, and today we'll try to complete the first topic, basic financial statements. So yesterday we covered two of the financial statement, your balance sheet and income statement, and today we'll start with statement of changes in equity. Okay, any doubts or questions still here? Clear? Okay. So in the statement of changes in equity, basically it takes a help of a balance sheet in the equity section, not liability, not asset. Only in equity section we are presenting it separately. Why do we present separately? Is because this is an actual money, who like owners' money it is. So they are trusting and investing in our company. So just we want to show them, see, your money is this much we have. So we are communicating with the investors or an equity holders. So yesterday we understood what are the 6 segments in the equity, right? So those 6 segments we are putting in the statement. That's it. So it explain beginning and ending balance for a fiscal year. In the stockholders equity account, what is the beginning, how it is coming as an ending, a story of beginning and ending. That's it. Each item. So yesterday we all know this is a permanent account, everything same. Okay. So now if I take all the 6 segment, so what are the 6 segments we had? One is common stock, additional paid in capital, then we have retained earnings, then AO, other accumulated other comprehensive income, non-controlling interest, and treasury stock. Okay, non-controlling interest and treasury stock will keep aside, and because that is one is part of a consolidation, and treasury stock will reduce your equity. That if you do minus, that's clear. And common stock opposite is a preference stock. Preference stock, we'll discuss that, but understand it is like a person who gets a preference in the liquidation. Okay, they are also stockholders only. So I'll write here preference stock. Okay, assume that the beginning balance of common stock was 1000, additional paid in capital was 9000, preference stock we had 2000, retained earnings we had around 5000, AOCI we had 200. Okay, so this was the beginning balance. How the common stock will increase? Any idea how the common stock and APIC will increase? From 1000 to increase and decrease. I'm not asking the total portion. I mean total, how much it will come? 17,200 is the equity part. If I take a balance sheet, okay, equity will be 17,200 because including everything is equity. So now each part, I'm not asking the entire part, only the single. How the common stock will increase and decrease? When invest or reduce. Yes, when owner invests more, it will increase, and when owner withdraw or treasury stock, contra equity. Whenever we send off the owner, withdrawal in the sense we can't tell as a dividend. I mean withdrawing their stock, like withdrawing their ownership. Suppose I was a owner, we 3 were owner in a company, then what we did, we had 33 percentage equally we were sharing. Then I told, then I asked the company, give my money, I'll give up the ownership. So I gave up the ownership and you paid me back. So now the common stock will go down. Same time the cash will also go down in this side. So the common stock increase and decrease, it depends upon issuance and withdrawal, or issuance or repurchase of shares. If we issue new share, it will increase. If we repurchase, it will decrease. We'll see the treasury stock accounting when we discuss about the equity, but when it will increase and decrease, it will increase and decrease in the same common stock and APIC preference stock. These 3 things. Okay, it will increase in issuance and it will decrease in repurchase of share. Suppose if they are investing more, it will increase. If they are withdrawing, if they are giving up the ownership, or if companies repurchasing their shares, it will decrease. Okay. Now we'll come to the retained earnings. How the retained earning will increase? Yesterday I told, right? Beginning retained earnings and ending retained earnings. What is the center part we had? Profits and loss. Increase and decrease depends upon the profit. So the retained earning portion will have profit or loss, and one more thing too, will have to make it as an ending balance. We have something called as dividends. Okay. So what does this dividend do is, so the dividend will decrease your retained earnings. The dividend means it's a distribution of a profit to a shareholders. Suppose my company had a retained earnings of 5,000. Beginning my opening balance was 5,000. Till today, we retained 5,000, not distributed. And this year my company made $1,000 in profit. Think that we made $1,000 in profit. So we took 1,000, we kept. Now it is 6. But we declared a dividend to common shareholders, preference shareholders, anyone. We declared a dividend of $500. This will be in minus. Okay. So the ending balance will be 5,500. So the formula of beginning to ending balance of retained earning is beginning retained earnings plus profit, and if it is a loss, minus opposite, minus dividends is equal to ending retained earnings. That's it. So this is working of retained earnings. Okay. It is not necessary in MCQ every time they ask ending. They give beginning and ending, and they might give dividend. You have to find profit. Then you have to reverse the formula and do it. Okay. Example, we'll try now. Suppose my ending retained earning is 5,500 and my beginning retained earning was 5,000 and I paid a dividend of 500. Then what we'll do? We have to find the profit. Okay. So then the profit is equal to what? So profit means, and here we have added, correct? So if we minus it is how much? We'll go in a reverse way. Okay. Ending retained earnings plus dividend minus beginning retained earnings is equal to profit. Ending 5,500, drawings 6, and beginning is equal to profit 1,000. Clear? So we'll anything, if they are asking about dividend, we have to reverse again. That's it. So we'll get 1,000 as a profit. So this is
this dividend will be calculated in the current year profit, right? Not the accumulated.
like they'll plan to give the dividend. So they will tell shareholders, we are giving you dividend. Each shareholder will get $1, or each shareholder will get 5%. The company will decide. For a common shareholder, it is like not fixed one. Sometimes they will give $1, sometimes they will give $0.5, sometimes they don't even give. It's not necessary. But usually for a preference shareholder, it is a fixed dividend based on the percentage. Usually preference share is written like this, 5% preference share, and they would have invested 1,000. So each year we have to give 5% of 1,000, whatever it is, whatever profit we make. So any dividend is a reduction of retained earnings. Okay. For a common share and preference share. Common shareholders, we might give more, we might give less, or even we don't give. But the rule to give a common shareholder is first you give to the preference shareholder, then only you have to give to the common shareholder. If you are not giving to preference shareholder, then you are not allowed to give to common shareholders. Okay. Then you know about the AOCI. AOCI, how it will increase or decrease? it because of OCI. If we earned $50 this year, our OCI is if $50, ending will be 250. Like this. Suppose we have not issued anything, then it will be same 1000, 9000, 2000. Usually this will not change in a company. Basically the retained earnings and AOCI will keep on changing because that is where the income and other comprehensive income lay. Clear with this? That's it with the statement of changes in equity. See, this is a statement of changes in equity. Preferred stock, common stock, additional paid in capital, retained earnings, AOCI. See, preferred stock, it does not increase, we kept like that only. Common stock, yes, it got increased because of issuance of common stock. And we have collected more 260, so it came in APIC also. So we issued a common stock and 220 and 260, which means we would have collected 280. In 280, 20 is par, 260 is additional paid in capital. So beginning plus, if you add, you will get this, plus you will get this. Then retained earnings, you see, beginning retained earnings plus profit minus dividend. This one is minus. Preferred dividend, common dividend, totally the dividend whatever they gave, $1028 we minus, then you have ending retained earnings. Beginning we didn't have any comprehensive income. This year we earned 211, so ending 211. So next year 2012 and we are closing in 2013, we know that this is a permanent account, right? So from where it close, from there only it starts, it opens from there. So last year it closed in 100, so 2013 starts from 100, and we had 100 preference stock, 100, and again we issued, we'll put, and here also add profit minus the dividend, you'll get ending retained earnings 211, and this year also we earned OCI, so ending 308. That's it with the statement of changes in equity. Clear with this? Easy, right? Statement of changes in equity. If we know that 6 categories, simple as that. And now we know how it will move. Common stock will move when we issue, or repurchase, it reduce, and preference stock same, move when issue and reduce. Retained earnings and the AOCI, it depends on profit and dividends. Okay. See, this is a statement of stockholders equity of Apple. So we were checking for Apple, right, for everything. So this is for Apple's statement of changes in equity. See, they had a beginning balance. We'll write beginning balance, total shareholders equity beginning balance was 56,000 total. Now each item's beginning balance is this. Common stock issued this year, they issued 1,498 common stock, and like common stock withheld, something repurchased, share based compensation. Sometimes they give us stock not in cash, based on the compensation. For employees they will give stock options, they would have exercise because of that. So like this, ending balance is this much. Next, net income, first of all it is in minus. Which one? The retained earnings is already in minus. Then this year they earned 112,010. If you check their income statement, you will be able to see this. We'll bring that income. Then dividend declared, we minus, and common stock withheld related to net share settlement of equity acquired, this 1,655. See, common stock repurchased, we minused in retained earnings. We'll understand why we minus in retained earnings, because there are different types of repurchase of common stock. Treasury stock is known as repurchase of common stock. Sometimes we repurchase more than whatever it value. We would have issued for $100 share, we would have issued for 100, but we would have repurchased for 150. It is not necessary the owners has to forgive 100 only, right? Because I was owner till today, so I want something extra, so we gave 150 and repurchased, so extra we paid, so that amount will minus from retained earnings. We'll discuss the treasury stock complete in detail. Now we'll understand how it looks like, because in Apple they have repurchased and they have minused from retained earnings, and they have an ending balance of 14,264, and this is accumulated other comprehensive income, same as that. Okay, see how it moves. Retained earning increase, net income. Net, if we have a net loss, retained earning decrease. If we give a dividend, retained earning decrease. If we issue common stock increase. Issuance of common stock above the par value. If we issue more than par value, where par value will go to common stock, more than par it will go to APIC. Okay, additional paid in capital. Next, total change in other comprehensive income. It will affect your accumulated other comprehensive income, AOCI. Now, repurchase of treasury stock will reduce total stockholders equity. Total means the total last amount is there, right? It will reduce. Obviously it will reduce because repurchase of treasury stock, asset side is reducing, equity side also will reduce. Okay, and this is for the retained earnings, how it looks like. Okay, retained earnings beginning plus profit minus dividend, and one more thing you see that's not very often, prior period adjustment. Okay, we'll discuss this prior period adjustment here, but understand this three. One, beginning plus profit minus dividend is equal to ending. Till here is it clear, right? Now plus or minus prior period adjustment will do. In like before this also we discussed little bit of it. Prior period adjustment means sometime in past we would have done some mistake. Because of that mistake, last year retained earnings would have affected. So we will not go and change all to this stuff in the last year. Last year, if the retained earnings increased, this year will decrease. If it is decreased in the last year because of some reason, will increase or do the opposite. See, in 2024, mistakenly we have not recorded the expense. $100 we have not recorded. Because of this, our profit would have increased by $100, and it would have affected our retained earnings by $100. It is not happened. This $100 profit didn't happen, but mistakenly we have recorded. But in 2025, what you do, because of the mistake you did, last year you mistakenly increased your profit, so this year you decrease your profit. So thus decrease will affect your retained earnings, because profits go and sit in the retained earnings. You go and directly adjust your retained earnings. Sometimes if you would have missed some income, or if you have over calculated our expenses, our profit would have gone down. This year you increase the retained earnings. So that is prior period adjustment. So prior period adjustment is done in two events. One, I told you, correction of error. One, correction of error. The example I already explained is because of the correction of prior period errors. We'll do this. Next, change in accounting principle. What is this change in accounting principle is, till the year we were following one principle. We were following LIFO method. There is a method in inventory valuation. We were following LIFO. Why? This is one principle. Acceptable. You can use LIFO or you can use FIFO. There is two methods, LIFO and FIFO. Based on this, our profit and our asset will change. Suppose if we use LIFO, sometimes our profit will be more, or sometimes our profit will be less. It depends upon the market price. But we have changed our principle. We came from this one to this, or principle change or something happened. Because of this, what happened? If you change the method, what happened? Our incomes will also change going forward. But here the rule is, we have to do retrospective. Retrospective means you have to change everything. Like in 2010, we started a company. We were presenting the financial statement from 2010. 2010 to 2024, we were following LIFO. like inventory valuation method example, and we suddenly changed into FIFO. You can't, you can do it, no problem, but you have to change your entire financial statement according to FIFO 10 to 2024, but it says if practicable, if you are able to. It is not necessary all the companies should have a data and work on it. If practicable, you have to do it. Or you don't have a data from 2010 to 2020, you have data from 20 to 24, so at least do it. Whatever practicable, you have to go and change it. So at last, where this effect comes and sit in the retained earnings, because at last income statement keep on affecting, everything comes and sit in the retained earnings. So go and adjust your retained earnings. Prior period adjustment happen in two events. One, if there is a change in accounting principle, and correction of errors. We call this as a retrospective application. So prior period adjustment is done only in this case. And one more thing is there, it is not done retrospective. We call this as change in accounting estimate. Accounting estimate means we'll change some estimate, right? Example, till here we were assuming that 2% of account receivable will not give. That was an estimation. Or we are telling warranty expense will be 5%. That was the estimation till day. But this year onwards, we are changing our estimation to 5 to 7%. If it is a estimation change, don't do anything in the past. Going forward, you do. That is called as prospective application. So retrospective means from first till here you change, that you will do in two cases. In the error also, you will not change from 2010. You will change from when the error happened till date. So that is retrospective means past you have to change. So that is done when there is a error and change in policy. But prospective you will do only when there is a change in estimate from today and going onwards. Okay. See, estimation of credit loss, which means bad debt or a depreciable asset remaining life. Sometime we would have purchased a car and we told the useful life is 10 years. But after second year, we came to know the useful life is only 5. Then from next year onwards, your depreciation will increase. Don't do anything in past. From this year onwards, you change, because this year only your estimate got changed, right? So then we use prospective. Okay. Here, retained earning is not affected, because we are not going to change anything in the past and affect our retained earnings. From today, we are going to change. So this prospective will not affect your past, only future. Okay, done with your retained earnings, done with your statement of changes in stockholders equity. And before we do cash flow statement, we'll understand this notes to financial statement. What is this notes means? If you take a financial statement of a company, they will give notes, footnotes of the financial statement. So in this footnotes of the financial statement, they will explain what is it, how we have calculated the inventory, and how we have calculated depreciation, how the assets came, how the assets increased, how the credit loss calculated. Everything will be in the notes of the financial statement. I'll show if possible. This is their report. Okay, annual report of Apple. So here we have everything. See there, income statement, the balance sheet, statement of stockholders equity, cash flow statement, notes. So in the notes to consolidated financial statement, so they will give the notes, what and all is there. See, basis of presentation, how we have presented, company fiscal year in 52 and 53rd week, prior ending of last Saturday of September. So this is till last Saturday of September we are presenting now. Okay, and what and all we presented, revenue, cash equivalent, what is cash equivalent, they are just giving a notes to the investors who and all is reading. So an extra note, how the income tax, next note to revenue, they explained about the revenue, which includes iCloud, Siri, map, what and all the revenue which they are bringing, everything they'll explain this. See, other, how much iPhone, how much MacBook we have sold, and the net sales, iPad, wearables, service. You see this, like, so how interesting. You see the iPhone they sold for 209 millions, and MacBook they sold for 33 millions. Not 33 million, it is in millions it is. So it's approximately the total sales, you see, 416 millions they are having. Okay, like earning per share. Now each shareholder how much they have earned. So nothing but they will divide net income divided by number of shareholders, you will get the earning per share. So cash and cash equivalents and marketable securities. See, each detail they have provided. So where and all we have invested. US treasury stock. We told marketable securities, right? So they are telling what are the marketable securities we have. Because as an investor, I'm worried, oh, where all these guys have invested. I don't know. See, as a company, as an Apple, okay, you fine, no problem. What if this is very small companies or a new IPO came, like recently there was a biggest IPO in US market was Starlink. It was Elon Musk company. So where it was like a trillion, they issued for $1 trillion. The valuation of a company was in $1 trillion. So very high valuation company. So then on all, you can go, you read whether you want to invest, you invest, you don't. See, this and all, as a individual investor, we use very rare. If you want to invest in any stock, you don't have, if you have a time, fine, but you basically will be not having that time. So we know the banks, right? Banks, mutual fund companies, money management company, investment banks, for them it's very useful. So however, if you are getting placed in this as a financial consultant or a financial advisor or analyst, a person who is managing a corporate finance, for them, yes, it is very useful. In Apple, not only as a retail investor we have invested, many banks would have invested, many mutual fund companies would have invested. For them, they'll go through each and every documents. So for them, they will provide, see, derivative instrument, what and all, everything is detailedly provided. It is called as notes of the financial statements. So the notes of the financial statement, the first note 1, if you see the note 1, what it is, it says significant accounting policies. How our accounting policy is, they'll explain in note 1. In the note 1, they'll explain what? A significant accounting policy, they'll explain. How we are maintaining our account books. Are we aggressive or are we conservative? When we are reporting, how it is presented, everything. It's good. Then note 2, note 3, note 4, note 5, it has like the one we saw, how our investment is, where it is our cash, who are our shareholders, earning per share, what and all we are selling. Those details they will give. Okay, now we'll come to the notes. So it says notes supplement, a supplement information explains the numbers in the financial statement. In the financial statement we gave the number, right? These notes explain it, how this number came. Okay, notes are not a technically part of basic financial statement. It is not a full set of basic financial statement, but it helps you to understand the financial statement. So notes are required as a part of complete general proposing financial statement. So we know what are the basic statement. We have basic statement plus notes plus supplemental information. We'll have financial reporting. Okay. So the note 1, I told you, right? The note 1 will be accounting policies. Whenever the statement claims to follow US GAAP, the company must include a summary of all significant accounting principle used. Here we use, see, they told revenue, what principle we used, expenses. So it try to explain the principles in the note 1. So it must disclose significant choice they made. Selection from alternative, like we use LIFO, FIFO for inventory. Which one we are using? That I have to explain. And principle unique to company operating industry. Each industry, different principles might be there. So what they have followed, how they are using the principles, that's it. So common, they'll use this basis of consolidation, depreciation method, amortization of intangible, inventory pricing and costing, revenue recognition policy, leasing revenue recognition. So these are things they will disclose in note 1. Okay. Note 1, they will tell how they are doing their accounting. Either they are liberal, choices boost current income in the short term. Example, if they are aggressive, we'll tell aggressive policies means they tend to show more income right now, not worrying about the future, using a longer estimated useful life on asset. Suppose if you use a longer you estimate useful life of asset, what happened to your depreciation expense? It will go down. If depreciation expense go down, what will increase? Income will increase. So that is aggressive method. They are not worried about anything. Go. Or conservative. Choice where we show income less or which is accurate, one, that is a conservative. Aggressive means it is not illegal or something they are doing bad, but it means we are, whatever the legal method they are following and using the policy to exploit it, that's it. Okay, example, you see a straight line depreciation 10 years 10,000 per year expense, but conservative it's 20,000 year expense. So they will show more expense and less income. Both company follows GAAP only, but by inspecting accounting policy, an analyst immediately see the company net income is 10,000 higher. Why? Because liberal depreciation assumption or aggressive. So not only seeing the net income, we'll go and check the notes, then we'll understand, oh, because of this reason this guy have made this much income. Then we can at least compare with some other company. Other company might be following aggressive, like conservative. This guy followed aggressive, so his income is more. Not because he is making from the core operation. Playing with the accounting numbers, he made some income. But this other person showed very less income because following as a conservative. How you understood? Not by seeing the financial statement, going through the notes. Next, note 2, note 3, note 4, whatever the notes a company want, there they will have other relevant information. Okay, changes in stockholders equity, marketable security, just we saw where and all the Apple have invested, contingencies and lawsuits, any lawsuits they have, like potential loss will be there, right? Potential loss means still yet it is not loss. There is a case going on, someone have filed a case on a company which is case going on. There is a potential of losing, means we have to report. It is not a liability still yet, until and unless the court is telling or 90% probable will lose, you no need to report on the balance sheet on a liability. But if the case is going on, if there is a chances you will lose, you have to report. Why you have to report? As an investor, you went and invested. Tomorrow what if there is a lawsuit which a company has to pay $50 million? Your investment obviously it will go down. Or there was a sanction on you telling that we are not going to purchase any item. The government tells you you can't sell this item. If already the case is going on whether to sell or not sell, you have to show in the notes. That is called as a faithful representation, right? You have to communicate to a resource provider telling these are the problems we have. Next, obligations, what and all we have, loan covenants, collateral pledges and everything, pension plan details, anything which other, everything will go in note 2, 3 and 4, whatever the notes they want there. But note 1 is for significant accounting policies. Clear with this? Any doubts still here? So we covered all of the three financial statement and notes, balance sheet, income statement, and statement of changes in stockholders equity. Okay, but these financial statement, before we go to cash flow statement, we'll understand the limitation. As we know, these financial statement do have few limitation in general. Not, I'm telling like all the financial statement. So measurement are made in terms of money. So qualitative aspect is ignored. Example, internally generated goodwill, a quality of a product or resource we have, employees we have, intellectual property sometime. This and all is ignored in your financial statement. A company is having a patent, but if it is internally generated, its value is zero. Suppose we are rating it as zero, but that is what providing economic resource to the company, but we are not reporting on the balance sheet. Why? Because it is GAAP says you should not. Okay, information supplied to financial reporting involves, it has estimation, classification, judgment and all. Few things we estimate and put, bad debt expense, warranty expense, contingencies and all we estimate based on the human judgment they will put. So this is also a major limitation. What if the estimation is wrong? Can happen, right? Yes, financial statement primarily reflect the things they occurred, or consequently many aspects of them are based on historical cost. One more disadvantage, the same balance sheet disadvantage is what we are following, historical cost method. The building example I told, building would have purchased for 1 lakh, today the value is 1 crore, but we can't write 1 crore in the balance sheet until and unless you are not selling the building. Okay, so a transaction only they are finance transaction they will report in financial statement. However, transaction of other companies such as competitor may be very important. See, competitors financial transaction will not report in our financial statement because to comparison, right? So if you want to compare, whether you want to invest in Apple or you want to invest in Samsung, so the comparison you can't get from the financial report. So this thing, and liquidation value, the balance sheet will not give a proper liquidation value. It is, we are preparing based on going concern assumption, assuming that a company will go for a foreseeable future. So these are the limitations of financial statement in general. So we covered financial statement other than cash flow statement. Only cash flow statement is pending. So before this, we'll try to do few questions till what and all we covered. We'll try to solve the all theory question. We'll try to solve this theoretical question, then we'll start with cash flow statement. Okay, try the first one. Statement of financial position means what? Balance sheet. Provide a basis for all of the following except. Balance sheet will provide all of this, but except something is different. That is wrong. The wrong answer will be your answer. C. Assessing liquidity and financial flexibility. So in the balance sheet, can you see the liquidity? You can't see liquidity. So we go in balance sheet, what and all will be there on the asset side?
Now we
Current asset and non-current asset will be there, right? So current asset means liquidity. So you can check the liquidity by seeing the balance sheet. Which one? No, that liquidation is different. That is called as liquidation value. I mean, here the liquidity means a cash what the company have. Liquidation value means, suppose if I close my company today, liquidating the company will tell. I mean, if I close my company today, what is the value, the true value of the company? I can't assess. Okay, but theoretically we can assess because equity is what the value left out. But market value you can't see on the balance sheet. That is called as liquidation value. And this is liquidity, means a cash what we have, like a current asset. So that you can see from the balance sheet, because we have classified as current and non-current. That is a benefit of balance sheet. Can you see profitability in the balance sheet or performance in the balance sheet? I told yesterday, when it comes to performance, it will go to income statement. So the answer is B, because this determining profitability and assessing past performance for the specific period, it's not provided by the balance sheet. It is provided by the income statement. Okay. Which of the following would not be current liability? See, all the four, I'm telling, like, this option is current liability, but they want an answer which is not a current liability. Sorry. So what would be an answer? See, whichever you don't know, you can leave it, but at least you can go by option and tell, okay, this is current liability, this is current liability, this is current liability. You received a security deposit from a renter for 1 year lease. See, if you're a landlord, I'm giving a deposit to you and telling that after 1 year, give back to me, which means it's a liability, first of all, because you have to give back. Within how many years you have to give back? Within 1 year. So it became current liability or non-current? Current liability. So this is not your answer. They want non-current liability or not a current liability. They are not telling non-current liability to, they are telling not a current liability. Next, a 10-year bond sold 110 months ago. I mean, I am selling a bond, means I have raised money. I mean, selling a shares means give the shares and get the money. Selling a bond means give the bond and get the money, which means I told bond will have a maturity date. On the maturity date, I have to, like, they will give the bond back, I have to pay back them, because that is a bond feature. But when it comes to share, you don't need to, not required to pay back to the shareholders. It's their wish. They have invested. Now I might give, I might not give. One time you invested, done. I didn't promise you I will give this much return, I'll give back your money. But bond, I told, see, I'll pay this much interest every year, and I'll pay back your money after 10 years. Here I am telling, after 10 years I'll pay back your money. But 110 months is already over. More, how many months is there to complete the 10 year? So in 10 year, how many months it will be? 1 year, 12 months means 10 year, 120 months. So how many months is already over? 110 months is over. So more 10 months is remaining. So which means I have to pay back money within 10 months. Is it a current liability or non-current liability? Current liability. It was a non-current, but now it became current. Okay. So this was also, okay. You received a rent for the current year on Jan 2nd of the current year. You got the rent for the current year received on Jan 2nd for the current year. It's a current liability because this year rent you got. Now you have to give the service. So this is also not an answer. So the answer is D. Undistributed stock dividend. So we know that what is dividend, right? Dividend means what? An appropriation of profit. From the profit you give to the shareholders. If you are giving cash, it is called as cash dividend. That is what till now we have learned. But stock dividend means a stock dividend by a corporation is distribution of additional shares. I'm not giving cash. I'll give what? Shares to you. I'm not going to, if it is undistributed cash dividend means will become current liability. But this is stock dividend. I'm not going to give cash, but I'll give what? Stock, like a bonus share. You have 10 shares and I'll promise for each 10 share you will get 1 share. If you have 100 share you will get 10. If you have 10 you will get 1. Like this we told to the shareholders. That means for the existing shareholders we are giving stock, not cash. So the undistributed stock dividend is not even a liability. First of all, this is not a liability. But undistributed cash dividend, declared cash dividend will be liability. I told to the shareholders I will give, each shareholder will get $1. That will become current liability. Why? Because I have to pay them a cash. Here I am not going to pay anything. Okay. First of all, this will not come under a liability part. Okay. Next, total cash expenditure that should be capitalized as property, plant and equipment. I mean, in the asset side, which are the, I have spent this much money. Okay. In this, what is considered as property, plant and equipment? We want to know. What is considered as PPE? That's it. Advertising, is it asset? I mean, is it a PPE? No. Computer? Yes. 12-month insurance policy? I mean, I paid 12 months policy now. Is it asset? It's an asset because it's a prepaid expense, but it is not PPE. But if I'm telling asset term, it comes under asset. But if I'm telling a PPE, no, it is not a PPE. We can tell it as a current asset because it's a prepaid insurance. But here they are not asking about asset, they are asking about the PPE. Suppose if the term is about asset, then you will rate. But this was not. January rent, no. Salary, no. Office supplies, we can consider as inventory or current asset. It doesn't come under a PPE. So no. Automobile, we have a car, it's PPE. January utilities, no. So the answer is 280 plus 30, 310. D will be your answer. Next, fourth one. Suppose the company pays one of the liability twice during the year. I paid liability 2 times. Then what happened in my balance sheet? Asset will go 2 times down, paying 2 times. Liability will also go 2 times down. This is happening. Now based on this, we'll select an option. Asset, income, by income. Does income affect here? If I pay 2 times liability, does my income affect? My profit affect? Oh. No, why retain? So if I'm, no, here they are not asking prior period adjustment. See, here the term is what? Net income. I mean income. Does it affect my income? What is a double entry if I'm paying a liability? If I'm paying off the liability, what is a double entry? Suppose I want to pay 1 lakh rupees to a person. I paid twice. So what is a double entry will have? Cash going out. Liability, liability comes down. This is balance sheet item. This is also balance sheet item. Net income is not a balance sheet item. So this income statement, and it doesn't even says it affects only liability and cash, which means liability and asset is only affected. No equity is affected. Next, asset and liabilities are understated. B will be our answer because asset is understated, liability is understated. Asset we written mistakenly, liability is also we written mistakenly. A primary objective of financial reporting. For why we are reporting this financial statement? To whom we are reporting? Instead I told a name. To a To the only for the owners? To for like what is the primary reason for financial reporting?
Give the business performance to internal and the external users.
But the primary purpose is not for the internal. They, that is secondary objective might be, but the primary objective is for whom? I told, right?
Yeah, assume like
Not managers, because managers are internal.
investors,
Only investors,
bankers,
creditors. So the answer will be
yes,
D. Suppliers, creditors, investors, everywhere. Not for managers, not for the staff, officer. Yes, we are preparing for them too. ABC, them too, but not primary. The primary reason is for investors and creditors. So we can term it in a single name called as resource providers. Economic resource provider. They are the one who is giving a fund to run the business. So economic resource providers. Okay. Next, what is the total current asset? We have this much transaction, right? In that, calculate only current asset. Humaira, you can also answer on the message box, and if you have any doubts, you can put on the message box. Okay, clear? Am I audible? Okay, fine. Okay, so calculate current assets. Sale, is it asset? Cash? Accounts payable? No, it's liability. Rent expense? No. Account receivable? Yes. Cost of goods sold? No, because it's income statement item. Land? No, it's asset, but it's not a current asset. It's non-current asset. Yesterday we saw the example, right? Contract liability, the name itself is there. Gain on sale? No, gain will go in the income statement. Equipment? No. Inventories? Payable? No, it's liability. So these are the things. Cash, receivable, inventories. How much it is? 35. It will be 35,000. Okay. Financial accounting provides information that can be used for all of the following except. See, financial accounting will give all the information. We can use this financial accounting, but not for one reason, for what it is. Can we assess the future cash flow? Yes, we can do it. Can we predict the stock performance by using financial accounting information? Stock.
if company performs well, obviously the stock value will increase, right?
Okay, but here it says financial accounting provide information that can be used for all of the following except for one thing it can't be used. Predicting the stock performance, we can't completely use a financial accounting information. The best answer, we might use, but in this 4 we can assess the future cash flow. Clearly we can assess, yes. Assess about the return. This year net income we saw, next year we can see the net income, how much we can assess. Make decision on providing the credit, yes, because for the resource provider only for creditors only we are making this, yes. So the best option would be B, because for the stock performance, not only financial information is sufficient, it has many other factors. Country's economy, country's cash, foreign exchange rate, demand and supply, availability, everything, many factors come in the stock performance. Suppose in India a Tata Motors is good, but what if as a country as a whole we are not that good, foreign investor will not come and invest. Okay, so then what happened, the stock performance will bad. But as seeing a income statement, we'll see, oh good, but if investors are not coming in, it provides a bad performance. So based on this, the answer would be B. Next. Okay. Each of the following elements of financial statement defined in the financial concept number 8, conceptual framework for financial reporting. Elements of financial statement. These are the elements, but one thing is not element. Which one it is? Historical cost. This is not an element. This is a measurement, a valuation measurement. Okay. So historical cost is one of the method which we report and value and measure in the financial statement. Now this one, we understood the formulas, right? Asset is equal to liability plus equity. Now we have to we are breaking that formula again. Another way to write accounting equation for a change in equity from one period to another period. From one period to another period, how the equity change. But now don't worry about investor investing and they are withdrawing the money, but we'll see how the equity comes. So opening equity we have. Okay. They want opening equity travels to closing equity. Now we can put this in a name called closing asset. Closing asset minus closing liability is equal to closing equity. Put this here. See, closing asset minus closing liability will give closing equity. Correct? Now from closing equity means the rest, asset minus liability is equal to equity. Now suppose if equity increase, okay, equity increase because of profit. Suppose if I earn profit, my equity will increase, and equity decrease because of loss or declaring dividends. Correct? By giving the dividends and something, my equity will go down. So these are the two factors my open equity and closing equity will affect. So now we'll rewrite this. How? No, try this, put this in the formula and try. Closing asset minus closing liability, you will get closing equity. Anything A, B, C, like if you're going through this, which one it would be? Closing asset minus closing liability. Yes. Okay.
Can you go to that?
Yeah. You take closing equity. Now I have everything right now, right? Now I'll take closing equity. Closing equity is equal to opening equity plus profit, got it, minus dividend. Simple as that. Opening equity, you add profit minus the dividend, you will get the closing one. And what is the formula for closing equity? Closing asset minus closing liability. Now everything we have. Now whatever the option we have in this A, B, C, D, what is the correct way to present the formula? Okay. Now closing asset is the closing asset minus closing liability, closing equity. Or I can write like this also. Closing asset minus closing liability is equal to the same formula. Opening equity plus profit minus dividend. Now it will be more easy. Closing asset minus closing liability is equal to, closing asset minus closing liability is equal to opening equity plus profit minus dividend, because this closing liability minus closing asset minus closing liability is equal to closing equity. Same formula again we broke. Now we'll write this. Closing asset minus profit, okay, minus dividend is equal to closing. What is this closing equity minus closing liability? Nothing. If you no Equity plus liability is asset, but equity minus liability, we'll take a random number. What if my asset is 100? Closing asset is 100 and my equity was will take this, liability is 40 and my equity is 60. Okay, closing asset minus closing liability is equal to closing equity, and we think that our opening equity was 50 and we made a profit of 20 and paid a dividend of 10. Then I'll have my closing 50 plus 20 minus 10 closing. So now we'll put this in the formula. Closing asset is how much? 100. Profit is how much? 20. Dividend is how much? 10. Equity is how much? Then it says my closing equity is how much? 60. Closing liability? No, 40. Sorry. 60 plus 40, 100. Okay. Now, see, by putting in numbers will make it easy, because as starting we have to put numbers, but once you practice, right, you will easily, you can do this question within 15 to 10 to 15 seconds. Now, if you put this formula, your answer should be correct. If it is not correct, it is wrong. 100 minus 20, 80. 80 minus 10, 70. But 60 minus 40, 20. So this is wrong. Okay. Closing asset 100. Closing liability how much? 40. Dividend 10. What was my equity? Opening equity 50. Profit is 20. So this should be 70. But we'll minus. 100 minus 40, 60. 60 minus 10, 50. So not this one. I should get 70, but here it's okay. Next, third one. Closing asset. Closing liability 40. Equity, opening equity 50. Dividend. So add the dividend. Oh, dividend is 10. My profit is 20. Now, after doing everything, I should get 20. 100 minus 40, 60. 60 minus 50, 10. 10 plus 10, 20. So, see, they have just rearranged the formula. Closing asset minus closing liability is equal to closing equity. But I minus the closing equity. Now left it what? Dividend. There I have added the minus the dividend. You add the dividend, you will get the profit. Because from the profit you have subtracted the dividend, right? You add the dividend, you go back. You are going from bottom. You add the dividend, you will get the profit. A profit before deducting the dividend. Okay, that's it. So this is an example. The asset we had 1 lakh, here 1 lakh 17,000, which means my ending asset. 25 liability, they have not changed anything. Equity they changed 75 to 92, which means how much? 17,000. Difference is 17. This 17 is affected by two things: profit and dividend. Obviously my profit will be more than 17 because I have minus the dividend. So after everything, my profit, you see here 20,000. If I paid a dividend of 3,000, they're clearly telling I'm paid a dividend of 3,000. So 17 plus 3, my profit is 20. Before deducting the dividend, it was 20, and after deducting the dividend, it is 70. Okay, this is little bit trickier question. Try this one. Here max, like what will tell, little bit trick which involves. See here, Sangs Incorporation always charge prepaid insurance when it purchases or renews its insurance policy. So they are basically they'll pay insurance in advance and renew when the policy gets expired. It adjusts the accounts for insurance used once per year. The 3-year renewal premium for a policy that expired on July 31st of current year was charged to prepaid insurance. The 3-year renewal policy is 63,000. They paid how much? 63,000, up 21,000 from the 36,000. I mean, this year how much they paid? 63. But I mean, for 3 years, they are paying for 3 years, right? So last time they paid 36, which means they paid 27 extra this time. So which means last time they paid how much? Last time they paid 36, this time they are paying 63 because price increase, we paid 63. It had cost 3 years earlier. When they paid this? Before 3 years we paid this. Okay. Now when we are renewing this on July 31st, it got expired and we are renewing on July 31st. The adjusting entry on December 31st, how it will be? Okay. The question is, how much is the insurance expense? How much is the insurance expense? In accruals, in revenue recognition or expense recognition, we'll explain right now only. The expense is charged when I use. Suppose I paid 12,000 rent on January. On January to December, I paid rent on January 1st. So on January 1st, is that an expense? It's a asset. Prepaid rent to cash. And on December 31st, I would have already used this service. It got expired now. The landlord will tell your time period is over. On the 31st December, what he will report?
Will reverse the entry.
But if you reverse the entry, does it involve a cash? No cash. So what entry will be there? No, prepaid rent is there with you now? No, you already used it. So prepaid rent you have used, which means asset decrease. Why asset got decreased? Because I expense. Yesterday we learned the definition of expense. Expense means a reduction in asset. It's reduce your asset. Rent, prepaid, because here we are not going and paying the cash again. This is the same concept will apply here, but with the calculation. 36,000 I paid when? 3 years before. So 3 years before means first we'll take monthly how much it is. So what will be the monthly expense then? 36 divided by 36. Because in 3 months, 3 years, there will be 36 months. So monthly how much it is? $1,000. And here we are paying for 3 years. Monthly how much then here? For 3 years we are paying 63 divided by 36. 1,750. Okay. Now on July 31st, I am renewing. We'll assume a number 2025. On 2025, July 31st, I am renewing with 63,000. Okay. And on 31st December, I am reporting this because they are asking for 31st December. How much expense I should record and how much I should reduce from prepaid insurance. So from Jan to July, did I use 1,750 or did I use 1,000? From January to July, 1,000. Because from Jan to July, we use the old cost. So it is 1,000 into 6. And from July, I mean July 31st is then, I mean 7, right? July 31st it is. I mean then it's 7. From remaining how many months is there? 5 months. So remaining 5 months I'm using the new cost. So how much it is? 1,750 into 5? 8,000? So total comes 14. Okay, 15,750. So 15,750 you're recording as an expense now. So which means debit insurance expense 15,750. And what you're crediting? Prepaid insurance with the same amount, 15,750. So B is your answer. See here, first of all, this is not, if it is 15,750, debit prepaid insurance 15,750, okay. Credit, no, we are not debiting prepaid insurance. They did opposite. We have to debit expense, credit prepaid insurance. Expense increase and asset decrease. Clear with this? So two things we are learning in this: one, how to calculate, and two, the double entry. Clear with this? Any doubts? So suppose if you're taking a Netflix subscription in the month of July 1st, you took a subscription for 12 months. Okay, you like for a company, you took a Netflix subscription and you paid 1,200 on July 1st, and on December 31st you're closing your books. How much is the expense you will record according to December 31st? So first we'll do monthly. For 1,200, if it is for 12 months, for monthly how much it will be? 100. How many months you used in this year? How many months you used? 6 months. So expense you will record only for 6 months. So 600 here, entertainment expense to Netflix prepaid subscription. Asset decrease, expense increase. And remaining 600 you will recognize in 2026. Clear with this? This is how you will record expenses.
Prepaid expense to cash.
No, we are not paying cash again, because on July 1st only we paid cash and we took the subscription. But we are using 6 months in this year, remaining 6 months in next year. Same in this insurance, right? 1,750.
So yeah, when we pay the cash, so we need to record, right?
Huh.
So the entry will be prepaid expense to cash.
On July 1st.
We are utilizing it.
6 months we are utilizing it.
So it becomes an expense.
Huh.
So
Expense to
expense to prepaid.
prepaid
We
expense.
need to reverse it.
Reverse means prepaid expense.
6 months.
So next 6 months what happened? Now 2026 we have, right? From Jan to July. So July means or June. From Jan to June we use the old subscription. Suppose the Netflix have increased their subscription. Now they are charging 2,400, assume. And again we paid 2,400. So the total expense will be 600. We would have used complete this. Now we'll do monthly. How much it will be? $200. Now it is 200. So the next 6 months it will be 200 into 6,000. So you use this 600 from the old. 1,200 is from the new, because they increase the price, we are following the new. Clear this? But still 1,200 is more left out. That we will use in 2027. Like this. So might be we'll use in the same year. Suppose we have not used in the same year, we'll put in prepaid insurance. On 31st December, we'll record it and we'll close this. Okay. Done. Next, a few questions on income statement. When a fixed asset is sold less than book value, which one of the following will decrease?
It's a long-term.
Long-term asset. The asset value, assume that it was 1,000, but we sold for 500. So we lost 500. So if we are losing 500, will it reduce our current asset? No. Net working capital. Net working capital formula is current asset minus current liability. No. Net profit. Yes. Because it comes before gains and loss. Profit before only will come gains and loss. So that C is your answer. Next. Company received an invoice in January for the electricity used in December and it record the expense in January. Is it correct or wrong? They used electricity in January. They got invoice, sorry, they used electricity in December. They got invoice in January. They have recorded in January. Is it correct? Is it correct what they have did? Humaira, is it correct or wrong? The company did correct or wrong? They did wrong. Why? Because they used when? December. So they have to present in December only. They have to write in December only. They are writing in January, which is wrong. The company use accrual basis of accounting. What is the impact now? What would have happened? They have recorded expense? No. So expense would have went down, profit would have increased. So that is what the answer you have to look. So which means operating expense overstated? No. Operating expense understated. Cash and cash equivalent were overstated. Cash matter only it will not come because nowhere cash is involved. Accrued expense were overstated. No. Accrued expense, first of all, they have not reported the expense. Then how accrued expense means outstanding expense. So no. D will be your answer. Current liability is understated. See, they have not reported the expense. So they would have not reported the liability also. Liability is not reported, so it is understated. And retained earning is overstated. Why retained earning overstated? Profits are overstated. Why profits are overstated? Expense are understated. So opposite. Expense understate will overstate the profit. Profit overstate will overstate the retained earnings. How are income tax on discontinued operation reported in financial statement? How to report the income tax on discontinued operation on the financial statement? Separately, right? So what will be your answer then? Okay. Do we record as an unusual expense? Do we record in the continuing operation? No. Because we told that intra allocation, right? Separate. Okay. We will record income from continuing separate, income from discontinued separate. So C will be your answer. Next, seventh one. Strategic shift, which means discontinued operation. On May 31st, they are planning to do this, okay? How should they report? Question is, can we report it as a discontinued operation or not? First question. Second question is how much? So first, by reading this question, we should understand whether is it a discontinued operation or not. So they are telling on 31st May of 2025 or 26, whatever, the last year 2000, last year May we are planning to, what we did, we were planning to discontinue this operation, and in November 30, this year November 30, last year May we planned to discontinue this, and this year November 30, like the assets on the line was sold on November 30, we are planning to sell this. We sold this. So on 31st this May, it became held for sale. If it is held for sale, it automatically became a discontinued operation. So no question about whether they did a sales or not. If it is held for sale, and it also says that they are planning, which means it shows that criteria, plan, program, actively marketed, it comes. So it came as a disc. Now the question is how much you should report. So they made a loss of 600,000. So 600 should be reported as unusual loss. No, It is not reported as unusual loss. It is reported as discontinued operation. So 600 should be included in the determination of income or loss from operation of a discontinued component. Okay, so do we need to report this as a discontinued component? Yes, we should. And 1 million and 1,600,000 should be included with revenue respective of continuing operation? No, it's not. 600 should be reported as a part of loss on disposal of component? No. So the answer is it is a discontinued contract, not a disposal of asset. It consider, even though we are selling this in November 30, but because we were planned to sell this on 31st May as held for sale criteria we are meeting, so it's considered as discontinued operation. Comprehensive income means, what is the formula of comprehensive income? What it is? 2 income. Add the 2 income, you will get comprehensive income. What are the 2 incomes?
Net profit plus AOC.
No, net profit plus OCI. AOCI is a part of balance sheet. So net income plus other comprehensive income will make comprehensive income. So which means what? Change in equity excluding owner transaction. Change in equity, comprehensive income means what? Change in equity excluding owner transaction, which means a non-owner sources which makes your equity change, that is called as comprehensive income. Okay, so this is about OCI. Yesterday we learned many items in the OCI, right? There was 5 to 6 items we learned. Okay, so they want only OCI. What and all will include in OCI? Investment by owner, is it a other comprehensive income? No. Foreign currency translation adjustment, is it a OCI? Yes. What if it is a foreign currency remeasurement? No, it's not OCI. It will be in the income statement. Net income, is it a OCI? No. So it is no, yes, no. Where it is no, yes, no. Fourth one, C is your answer. Next. No, they want comprehensive income. Don't get confused. They want comprehensive income. So remeasurement will come in the comprehensive income. Yes. Dividends, will it come in the income? Dividend paid to owners. Do we really show dividend in the income statement? Is dividend is an expense? No. So it doesn't affect your income because dividends will come after profit. Dividend is a separate story. It will not go to the income statement. It will reduce your equity. So is dividend is your income? No. Loss on discontinued operation, is it comes under comprehensive income? So loss on discontinued operation. Now if you take an income statement, because loss on discontinued operation will affect your net income will affect the comprehensive income. So yes. So yes, no, yes. 2 is your answer. Okay. Next, accumulated other comprehensive income reported in which of the financial statement? Where you will report this? Balance sheet, income statement, cash flow statement. Or statement of comprehensive. Where you report the AOCI? So what are the 6 segments of equity? Common stock, preferred stock, retained earnings, AOCI. AOCI where it comes? In equity. Equity where it comes? Balance sheet. So some students will get confused and they will tell comprehensive income. No. AOCI will not come in comprehensive income. Only OCI will come in comprehensive income. What? Calculate the comprehensive income. Comprehensive income means net income plus other comprehensive income makes comprehensive income. Net income, can I take net income? Yes. Can I take depreciation? No. Why no? Depreciation will come in P&L. Why we are not taking depreciation is this depreciation is already affected your net income. So no need to again minus or add this. Okay, because Depreciation is expense. Net income is at last. Already we got the ending point. Why we want to go and take again depreciation? Not required. Investment by owners? No, it's not income. Unrealized gain on available for sale debt securities. Yes. Does it come under net income or does it come under OCI? It comes under a OCI. But it is gain, right? Add. Then we have a translation loss. Yes, it comes under OCI, but it is minus. So 950, 90, 140, 1 million, 1 million 40 minus 20, 1 million. B will, no, not this B. 1 million 20, right? 1 million 20 will be your answer. Clear? 950 plus 90. 140, 1040 minus 20, 1020. So 1 million 20,000. Next, calculate the comprehensive income. Oh, no, sorry, only other comprehensive income. So net income will come under other comprehensive income, but it comes in comprehensive, not in other. Translation gain. Yes, translation OCI. Investment by owners? No. Remeasurement loss? No, because it comes under net income. It comes before the net income. Deferred net periodic pension cost. Pension cost? Yes, it's OCI. Unrealized gain on available for sale of debt securities. Yes, but this is in minus, okay? Because it is a cost. Dividend to owners? No. Deferred loss on cash flow hedge? Yes, because it's hedge. So it is minus. So try this. So answer is 5%. Because this one is loss. And see, if like by doing this more MCQs, right, you'll come by reading the textbook, what you'll know, you read the examples and go. But when you're actually practicing more MCQs, if you keep on doing this, next time you'll not worry. Translation, OCI. Pension cost, OCI. But once we read the text concept, concept clarity is required. So we'll read the textbook or notes, whatever. But doing more MCQs will reduce time taken to answer the question, because here in the CMA 100 questions, only 3 hours. So time, you might have a concept clarity, but it is not necessary you might have enough time to answer. So that is a problem here. Only 3 hours you have for the 100 MCQs. Hardly you might get below 2 minutes to answer one particular question. So that problem comes. So only concept clarity doesn't reach to a positive result. You also require speed, accuracy, both. You have accuracy but you lack speed. No, doesn't work, because you will left out with some unanswered question. And you have speed but no accuracy, means you put everything, every option you select and go, speed is there. But both matters, accuracy and speed. So how it comes? Concept clarity gives you accuracy, practice more question gives you speed. Yesterday I told, right, concept clarity is topmost. Practice more MCQs, do more mock questions, you will reach. So the students, where they will, if you're lacking behind speed, means your accuracy will, you lose accuracy. At last you will get panic. When you get panic, your calculation will go wrong, you select wrong answers, these things happen. So what I suggest is, whenever you complete the topic, do the questions, so your concept clarity will also be stronger. And whenever, if you have a software of Hawk, whenever you do this, for right answer it has explanation, for wrong answer it has explanation. So whenever you click the wrong answer, right, read why it went wrong, so you will not make mistake again, and go and read a right answer too, so you'll understand what is the thing you have to rectify. So read a wrong option and a right option too. And some question in confusion you would have selected, fortunately you got a correct answer. But if you think that if you're not assured and you selected by randomly, you got right answer. For that question also, you go through right answer and wrong answer. But any question which you are 100% sure, you have concept clarity, that you no need to waste time. The question which you made wrong and the question which you were like selected in doubt, those questions, you'll understand which question you have to practice, which not. So when you will understand, when you do more, you will get. So you have a material of Hawk, and in ArivuPro also you have LMS. It have few questions, and you will also get mock test from ArivuPro side, so that when you do all this, you'll get into the picture. So what I suggest is do more questions, MCQs, rather than reading multiple textbook. Like we have a textbook from Hawk, Glim, Wiley, and all. Students, what they do, they will read the textbook. I suggest read one text, stick into one material, one textbook, any one. If you want Glim, go Glim. If you want Hawk, go Hawk. But the problem is, if you are referring more textbook, time waste. Okay, but you do more questions from any materials you get. There is no problem in doing questions from any materials you want. You do Hawk, Glim, ArivuPro, any materials you get, you do it. But textbook don't do, because if you want to do, you do, but it wastes the time. Because same thing you are reading in this textbook, same thing in one textbook, it will explain more. In one textbook, it will explain less. So if you want more concept clarity, refer the textbook which have more explanation. Then referring more and referring less, referring less, referring more. Don't do this. But do more MCQ questions. It helps. If in a few topics you lag behind. Example, yesterday I told tax. In deferred tax, what happened? More confusion, right? Do more questions, and few you will be okay. You know how to do what is current asset, what is non-current asset. Don't do more questions. Okay, if you have time, do. If you don't have time, focus more on question which you have more doubt. More doubt, more question. That's it. Okay. So yesterday we learned an example. Now when we apply practically, this will get stuck in your mind. See this, 5,000. How we got 5,000? Because translation gain, deferred tax pension cost, available for sale security, and derivative of cash flow hedge. The difference between foreign currency translation gain and loss and a foreign currency remeasurement gain and loss. Yesterday I told remeasurement, translation, foreign currency translation gain and loss are reported in OCI, and remeasurement is reported in net income. I think last one in your comprehensive income. Try this. Which one is correct? So you want to find net income, comprehensive income, and AOCI. These three things you have to find, and which one is correct, that you have to select. Okay, it's kind of multiple choice question with multiple answers. So first we'll understand what is the opening balance of AOCI. What is the opening balance? And they want what? Closing balance. So what affects the closing balance? OCI. If you know OCI, you can find everything. Things are sorted. So we'll find the OCI. Only if we'll find the OCI. Foreign currency translation gain comes under OCI. Unrealized loss on trading security, no, not trading security. Unrealized loss on available for sale of debt securities. This both you take. So how much it is? Okay, first tell me what is the OCI you got. Only OCI. Huh? Minus
19.
minus 19, which means loss. Then you got the ending. What is the ending? 339. Correct. Now you can do one thing. You can scratch this both. Obviously that other two option is not an answer. Like this you can save more time. Now you have OCI. Now what you want? You just want to calculate net income. How to calculate? Then either the net income is 607 or 677. Whatever it is, you got. Other thing you no need to calculate only. You got correct answer. So what is my revenue is 1,700,000. We'll use this also in the calculation. Yes, we use this. Operating expense, yes, we use this. Gain on sale of land, yes, because it comes under, okay, gain, I'll not minus, add this. Next, unrealized loss on trading security, yes, because if it is not coming in OCI, where it will come? It will come in net income. Now add and minus this. 1,700,000 minus 750 minus 285 plus 35 minus 23. 6,77,000. So not this. You don't need to waste the time to calculate the comprehensive income. You can get. I'll finish more 5 to 10 minutes. Right?
The session will be over or
No break.
okay. So let's get check in.
Done.
Done.
Okay. So which one? Option 2. So this is where A. Okay. So if you want, you can check how to calculate net income. I mean comprehensive income. Net income plus, which means now it is in minus comprehensive income. You should get 658. Then it is comprehensive income. In exam, you know, if you don't waste the time only. Do done. Okay. Then you can click. No need to use that extra 10 to 15 seconds to calculate this. Then you got your answer. Next, statement of changes in equity. A statement of changes in stockholder equity shows what? That's a question. Statement of changes in stockholders equity. What does it show? It had a beginning balance, right? Then it had some adjustments. Then it get a ending balance.
Retained earnings.
Only retained earnings.
D.
D. Yes. Reconciliation of the beginning and ending balance in the individual stockholder equity account. Each account, not only retained earnings. It's reconciliation, right? Opening, ending. Then we do some adjustments. That. Next. What is the primary purpose of the notes to financial statement? Does it have a marketing and sales performance to the primary purpose is to explain marketing and sales performance? Notes? No. Does it disclose a competitor details? No. See, the odd one we can scratch it out. To present a true picture of company's financial position and the results of its operation. Or will it explain the business strategy? No, because no company want to explain their plans and strategy, right? So it will not. They will tell what we are planning to do, but how they will not tell. So B will be your answer. Yes, it shows the financial position and results of its operation. It shows the true picture. I explained the different depreciation, right? So it shows a true picture how they got a net income. Okay, clear? Okay. So the notes of the financial statement are meant to give a comprehensive understanding of company's health and operational result by explaining the figures reported in the financial statement. Whatever I have reported in the financial statement, it gives an understanding how we arrived at this number and assumption and accounting practices, whatever we used. Okay. So yeah, we'll take a break and then we'll start statement of cash flow. Okay, any doubts still here on this three financial statements? Comprehensive income, no, clear? All the part, okay. So in this, the cash flow statement, so we have an income, we have balance sheet, we saw the statement of changes in equity and everything. But why the cash flow statement is required is, see, ultimately everything have to be converted into cash to get an income to earn, to pay anything, or to pay salary, to pay for the dividend for our investors and everything. A cash is involved. It's not like you're showing your net income, you're showing a high profit, but you sold everything on credits. You did a sale, you gave a lot of discount, or you gave a liberal credit policy. You told to your customer that you give money after 90 days, or after 180 days, or after 9 months, or after 1 year. What does it create? It, because of this, everyone will come and purchase from you. Because of this, your sales will go up, your net income will go up. But does your cash go up? You did this, you manipulated the investor now. Suppose if you are not showing the cash flow statement, the investor will get, oh, so these guys are doing a great profit, good sales they are doing, let me invest. That one reason. And here we'll understand from where the cash is coming in and where the cash is going out. So the primary purpose of cash flow statement is to provide an information about a cash receipt and cash payment of an entity during a period, from where the cash is coming in and where the cash is going out. Okay. So in the accounting period, to achieve this purpose, to disclose this cash receipts and cash payment, we do create our statement of cash flow. So this statement of cash flow will be able to analyze all this information. Future cash generation, how much we can generate a cash from future, and solvency and financing need, and ability. If you have a more cash, it means you're solvent, you will be able to meet the debt obligation. Suppose you have only $50,000 in your bank, and within next year you have to pay $1 million of loan. So it shows the solvent, no, you are in danger now. So next, income versus cash differences. So we'll be able to understand how our income look like our income and our cash flow statement. See, net income will be not equal to our cash flow, correct? So net income will be difference and our cash will be different. So how you will understand? By showing a cash flow statement. Financial position impact both cash and non-cash investing and financing activity, overall financial stability, from where the money we are getting, right? Financing and investing activity, where we are investing, from where we are getting the money, and all those things can be seen in the cash flow statement. So in the statement of cash flow, which means cash and cash equivalent, and we already know, like, cash equivalent, to be a cash equivalent, what is the criteria? The criteria is anything which you should be able to convert cash immediately without losing its value, and you should know its known amount, and also the criteria of 3 months, that from the purchase date to maturity date it should have only 3 months. So might be we'll invest in money market fund, commercial paper, T-bills, a short-term investment will do, not in the stocks, okay, like in security funds. Might be government is asking, give a loan for me, within 60 days I'll pay back. You will not lose money because government will pay back your money. That doesn't have a significant loss at all. And Apple is coming, like Apple company is coming and asking for commercial paper, give us a few loan for 60 days. We'll give the loan and we'll get the money in 60 days. So that and all will consider as cash equivalent only. So cash means cash in hand, cash equivalent, and restricted cash. Everything will come under this statement. You see, the difference we see. A growing tech startup having an income of 500,000, its income statement. We have an income of 500,000. Almost all of its sales were from credit. Everything it came from account receivable, and customer have not yet paid the bill. Meanwhile, the startup has his they have to pay to his engineers, salary they have to pay. But this 5 lakh, they got a net income, right? Major amount came from where? Account receivable. So do you have the cash of 5 lakh right now? No. The statement of cash flow reveals an operating outflow of 1,000, but we have to pay $100,000 to our engineers. Even though income statement look profitable on paper, the cash flow statement will not see that. You'll be not able to see that on the cash flow statement. Why? Because my fund is stuck with the account receivable. In part 2 we learn how much, see, the fund stuck with the account receivable is a loss for us. Suppose if we had a fund, suppose if you would have taken a loan, we would have paid it, but because of this fund stuck, I am paying an interest on that fund, assuming that we took a loan. So that is a problem with this account receivable in inventory. Even in inventory also, you bought, like, you're doing a manufacture and sales of furniture, you will have lot of inventory in the godown. In the warehouse you will have lot of inventory. It doesn't feel good. Why? Because your money is stuck there. Having more inventory doesn't mean you are doing a good business. Might be your inventories are, you're not able to sell the inventory and your money is stuck there. Your funds are stuck. So that provides a bad impression, like, which is not that good. Having more inventory doesn't feel that good. Example, in one episode of a Shark Tank, one investor came, they approached to the investors, company came, they approached to the investors, they didn't have fund in their bank account, but they were having a lakhs and lakhs of inventories, which shows that they are not able to sell. So in that company, will you invest? No. You are reaching a next month where you have to pay to your employees, you have to pay to the laborers, you have to pay electricity, rent, you have to pay the interest and everything. And in the bank account, you don't have a fund. You have literally a bare minimum fund. But in inventory, you have a lot of, if you're able to sell this inventory, it's sorted, but you are not able to sell. So, but if you see the balance sheet, wow, nice, they have more asset. But if you see the cash balance, you see, no, they are bad. They are having a lot of inventory doesn't mean they are doing good. Inventory should be lot when your business is more. Your business is 1 crore business, having a 10 lakh inventory is reasonable. Having a 10 lakh business and having a 1 crore inventory doesn't feel, it means that you're not able to sell the inventory. You might be selling an outdated, you might be having an outdated furniture or outdated fashion, if you're in the cloth industry, or might be having an outdated dress, so which means you're not able to sell it, go just for the scrap now. Okay, so the net income and cash flow you'll be able to understand. So now, in a company, from where and all company can expect a cash? How and all a company will get a cash? See, you are running a company, from where and all a company can get a cash? By selling the goods and by giving the services. What we call this as? Sales. Not only sale, we call in umbrella term. We tell this as operation. Operating income, operating. By operation we can do. By operating activity, we can get the cash. Okay, one is operation. Next, from where we can get cash?
Loan,
bank loan, or from the investors. My company, I am investing, or I am going to bank is giving a loan. See, here the matter is, from wherever I am getting a cash, I'll put here. Operating means by doing the business, I'll get a cash from the customer, I'll put in operating. From investors and banks, this we call as financing activity. Two, and one more place is there, we'll get cash. One more. Selling of assets. Suppose if I sell my assets, I'll get cash. That is called as investing. Suppose I am selling furniture, but I had a old delivery van, I sold. I'll get a cash, right? Yes, I'll get a cash. But does it from an operation? No. Does it from a finance? No, it's from investing. So the cash flow statement is categorized into 3 activities. Anything you name in this, you can put it. Anything, any cash you can tell, you put it. You got a refund from the government, operating activity, because tax you paid, you got refund. Any cash you give also, it is not only cash inflow, both inflow and outflow. You can put anything in this three activity, anything you name. Like suppose they are paying a dividend. To whom we are paying a dividend? To owners. Financing activity. They are the one who gave the fund, we are giving back. So that comes under financing activity. They purchased machine, investing activity. When I purchase machine, I'm getting a cash or I am giving a cash. So it's outflow. I'm selling a machine, then inflow. So in an opposite way we have to think. And cash received from the customer, operating activity. Sales, no. Sales doesn't mean activity. Cash collected from customer, yes. All the sales will be not equal to cash. Some sales might be credit sales, some sales might be cash sales.
Cash sales be recorded.
We can't tell cash sale, we can tell like this: cash received from customers. That means cash sales plus cash collected from credit sales. We'll put like this. Okay. So these are the three activities: operating, investing, and financing. So this is how the statement look like. Cash provided or used by operating activity, cash used or provided by investing activity, cash used or provided by financing activity. We add everything, add or minus. Sometimes they give, sometimes they use. Use means more out. Give means like more inflow. Okay, so after everything we'll know how much increase or decrease in this year. So suppose beginning balance I had how much? 6,000. Ending balance I have how much? 30,000. That means from this three activity, how much cash we got, which means inflow. It show purely inflow, right? I had 6 in the beginning, at the end I have 30. That means it is inflow or outflow? Inflow. So how much I got inflow from all the T activities? 24. So from this three activity, we call increase or decrease in cash and cash equivalents is 24,000. So from where and all we got? Operating, investing, and financing. See, operating activity here 20 inflow, investing activity 5,000 outflow, and financing activity 9,000 inflow. Okay. See, here it looks easy, but what if they are providing a 2 years balance sheet and income statement? You have to prepare by using 2 years balance sheet and by using 1 year income statement. You have to prepare this operating, investing, and financing. But in here it's an MCQ. Here you are not going to prepare it. No one will ask you to prepare like draw, but they might ask a question in this. Majorly we are going investing and financing activity. It's easy, nothing. Investor are giving, investor are taking their money, giving the dividends, done. Investing activity is what? You buy a machine, sell machine, invest somewhere, outflow, sell. Operating activity is little bit complicated. Okay. So now preparation of statement of cash flow, operating, investing, and financing you add, you will get your cash flow. So this is a format of statement of cash flow. First you will write operating, then you will write investing, then you will write financing activity. So operating activity, inflow, everything you have to write separately. You should not net it. Inflow, outflow, you do, you will get from operating how much. Inflow, outflow, you do, you get in investing. Here you get from financing. Then you add everything, you will get net increase and decrease in this year, plus opening balance, you will get closing balance. Okay. Now supplement means few non-cash activity we have to mention. We'll discuss that. Few non-cash activity also. This is how it look like. So operating, investing, and financing, inflow, outflow will get from operating, financing, and investing, everything. Then you will ultimately write. So this balance is there, right? This balance will be equal to your balance sheet. In balance sheet you have a cash and cash equivalent. That amount and this amount should be equal from all this activity. So if we have given 2 years balance sheet, right? Easy. Opening balance you have closing balance you have, because 2 years balance sheet. That net increase and decrease you got. The difference between you. Sometimes they will give complete a huge question like this, a big question. The question what they will asking is, what is the net increase and decreasing from all these three activity? No need to invest time going through all the line item. Just take beginning cash, a cash equivalent, ending cash and cash equivalent. See the difference. That is what the cash provided from this three activity. See, these things happen in CMA US. They will give a big question. They will give income statement, balance sheet, lot of information they'll give. Don't worry about it. Go last line, check the bottom last line, what they want. By understanding this, you don't need to invest this lot of time. This trick you will explore automatically when you do more and more question. So now you just take beginning balance, ending balance, sorted, 15 seconds question. But if you go invest and spend the time to read the question, only takes 3 minutes. Going line items, each line items you have to go. So now you got a trick to find. Now if they're asking what is from the operating activity, then we have to go and check from the operating activity. Clear with this? So by using the balance sheet, you can find what is the net increase and decrease in the investing, financing, and from the operating activity. Okay. Cash inflow and outflow are presented separately. You have to present it separately. You can't net off. Inflow and net outflow you can't net off and write in one line. So cash inflow and outflow for investing and financing activity must show in the separate line. And operating activity, there is an exception. What exception is? Here you have two different method to present. We call one as a direct method and indirect method. Investing and financing, only one method. It has a direct method, but operating activity, we have two different methods. One is direct method and indirect method. In part 1, you should know a category where what item goes. I mean, which item will go in operating, which item go in financing, which item go in investing. And also, here you don't need to prepare it, but you should understand how you will be tested on direct method and indirect method. If you do direct method and indirect method, the answer is same. Methods are different, but ultimately how much operating give, that much you will get. So it's not about which method you use. Some question they don't worry about the method. They want what is an operating cash flow. Whichever is easy for you, you do it. Okay. And few question they will not give a data related to indirect method. Then you are forced to use direct method only. Okay, we'll learn. Okay, direct method and indirect method. So cash flow from operating activity. First we'll go operating, then investing, then financing. In cash flow from operating activity, we know that we have two different types of method to present this. One is indirect and direct. Okay. Operating activity means any activity which is not from investing and financing will go in operating. So if you learn investing and financing 100%, you don't need to learn operating only, because you automatically know what comes. These cash flow are primarily tied to company's day-to-day operation, core revenue, and directly will come in the net income. But don't think if what and all come under net income will come in operating activity. Day-to-day and revenue producing operation. Day-to-day and revenue producing operation will come under operating activity. Now, gain and loss is there, right? 4 components we learned yesterday: revenue, expense, gains and loss. So for the gains and loss, transaction that trigger accounting gains and loss, like selling a piece of equipment, are not operating activity because they fall under they fall outside the regular daily business. Suppose company sold machine, they will have a gain, right? Gain where you will report in the income statement under under the income from continuing operation, but after the operating income, correct? But it comes in net income. So what you have to do, you have to exclude that from the net income to get your cash flow, because a gain on sale of equipment or a gain on sale of asset is not operating activity because it is investing activity. Clear? See, my company purchased a machine for 1 lakh. Now the book value of the machine is 50,000, but we sold for 60,000. 10,000 profit. Yesterday we saw for some bakery and we had some profit. So 10,000 where you will report in income. Here what they are saying is no, you should not report under the you should report under the income statement, but you should not report under the operating activity. Operating cash flow you should not report. Clear? Okay. What are the cash inflows we have? We'll see. We'll understand this concept, then we'll try to prepare one statement. Done. So what are the cash inflow? Cash received from selling goods or service, including the cash collection of account receivable. Cash sales and cash collected from credit sales we consider as cash inflow. This is one. Cash received as interest on loan, dividend on equity security comes under cash inflow. According to the GAAP, it says you gave loan to someone, right? Not you took. You gave loan to someone, you pay the interest. It's cash inflow from operating activity. Okay. And you would have invested in some other company stock. Suppose you invested in Indian Oil and Indian Oil is giving you the dividend. You will get the dividend, right? You are getting a cash. That will come under the operating activity. But it feels like it's an investing activity. No, but it comes under operating activity under the GAAP. Okay. These two things. And royalty, corporate fee, commission, any other revenue stream we have, any other secondary revenue we have will come under operating activity. And cash received from selling debt or equity instrument classified as trading security, especially for bank, brokers and dealers. Okay, this is for bankers. Bankers, how they will earn? Through commission they will earn majorly. Selling debt, equity instrument. Suppose investment bank and a company is coming and telling, see, try to sell my company shares and get the money. So I'll take some commission for that, right? So those and all will come under a cash inflow of because their operation is that. Their operation is to get the money, sell the equity and sell the bonds. So that comes under a cash inflow. And any investment classified as trading security will come under cash inflow. Yesterday I told investments, we can debt investments or investments we can consider in 3 categories. One, available for sale debt investments, held to maturity and trading. Available for sale, yesterday I told whenever I want I'll sell this, whenever I want money I'll sell this. So reports any unrealized gain or loss in OCI. Held to maturity, no, will not report in OCI because held to maturity we are planning to hold till end, so no need to worry about it. Next category we have trading security. Trading security intention is I'll sell whenever I saw profit. I'll for a short time, today morning I bought, tomorrow morning I'll sell. Whenever I see a profit I'll sell. In the intention to make a profit in a short term period will come under a trading security. That also will be considered as cash inflow from operating activity. Don't put that in the investing. It's like you are investing only, but here the intention is what? Sell today and get the profit as soon as possible. So that will come under a operating activity. And available for sale and held to maturity is investing because there you are actually investing and keeping the money. Clear with this inflow? Now we'll see major inflow is from the sales, from the interest and dividend income, commission, trading securities. Now outflow is what? Opposite of this. Payment to the supplier, payment for raw material, notes payable, suppliers, everything. Salary, wage, payroll benefit, and operational duty, fines, income tax, everything comes under operating cash outflow. Next, interest paid on bond, mortgage, bank loan and finance lease is also considered as operating cash outflow. Now we took a loan. We took a loan and we'll get a cash. Operating activity or financing activity? Financing, because it's not by doing a business you got from the bank. You are paying interest to this. Interest is operating activity. Repayment of principal is financing. Example, you took a loan of 1 million. Money you will get, it's financing. Now yearly you are paying 50,000 as interest. Interest is what? And time came, you are paying back the money. To whom? You are paying this 1 million. So that will be financing outflow. Okay, but interest is operating. Next, CATs spend to settle long-term asset retirement obligation or contingent liabilities. Suppose contingent liabilities and all will be there, right? One example of contingent liability for past business acquisition is, suppose you acquired someone else's business and he kept a condition that suppose if your business is doing exponentially, I'm not an owner now, you have to pay me some amount. Now there is a condition. If a business is making exponentially, then only I have to give. If not making, I no need to give. Suppose if we made, if you are giving, that also comes under operating cash outflow. Very rare. And asset retirement obligation is, you have an asset, you installed a machine, now you want to sell it. While doing that, if you're spending anything to sell that, it comes under operating. Asset retirement obligation means it comes under operating cash outflow. Clear with this cash inflow and outflow? For lease, we have special rules. Lease, we'll discuss more on lease. There are two types of lease. One is finance lease and one is operating lease. One is financing lease and operating lease. There are certain conditions we'll discuss in the lease topic. Okay. Now, in this, we have certain rules for lessor and lessee. Lessee means a person who took a rent. If it is operating lease, if it is comes under operating lease, all cash payment will consider as operating outflow. Simple as that. Operating lease, all cash payment will consider as operating cash flow. But I took a crane, okay, under operating lease. A lease is nothing but you take some asset, you pay the rent each year, that's it. I took a crane under operating lease and I used this crane to construct a building. Then it will never ever come under operating activity. It will go to investing activity. Why? See, building is what? Investing or operating? Investing. Any money you are spending to construct a building is called as, no, any money you are using or spending to construct a building is called as investing activity, because you are investing on building. Now you are spending on crane for what purpose? To construct a building. So that spend will automatically go to investing activity, because then it will never worry about financing or financing lease or operating lease. Any lease you are taking to construct another asset, that comes under investing activity. So that's what is in the bracket I have mentioned. If the payment directly cover cost to bring another company asset to construct any other asset to the location and condition, it is investing activity. Or else, if they leave about this exception, or else operating lease, all cash payment, operating outflow. Finance lease will have two portion, interest portion and principal portion. Interest portion is operating outflow. We just saw, right? Interest on lease is operating outflow. So in the finance lease, what are the two portions we have? Interest and principal. Interest portion is operating outflow. Principal portion is financing outflow. Clear? Lease is little bit like tricky, as I told you. When it comes to lease topic, you'll understand what is finance lease and operating lease. But right now, you understand operating lease, all cash whatever pay under operating lease, operating cash outflow. Finance lease, only interest portion is operating, principal portion is financing. Clear? Operating, yeah.
We took a loan to purchase. We took a lease on crane.
Crane.
So it comes under operating. But if we build construction, construct out of that crane, it becomes an investing. Now, if we pay the, if we give back the crane, so it will come under finance.
No, if you give back the crane, done. See, that is what operating lease does. I took a crane for three months, right? Assume that for 3 months we are paying 30,000. Okay, so what you will record in the balance sheet is, you record 30,000 asset, you record 30,000 liability. This is how the lease work. When it comes to lease, I'll show detail work. Then what I'll do, I'll remove the asset and I'll remove the, but here when I'm writing 30,000, I'm getting cash? No, I'm not getting cash. So I'll do this, and each month I pay 10,000 as operating lease. Suppose this crane is used for the building, I'll put this 10,000 in the asset as an investing activity. Then I'll give back the crane, asset removed. However, I paid him 30,000, I want to pay him, I paid this, liability is also removed. That's it. So cash involved, if you're telling, I took a crane for a normal business purpose, not for the construction of a building. I use this crane for the operation purpose. If it is an operating lease, operating cash outflow. But by using this crane, I constructed another asset. Then it comes under a investing. That's it. Simple.
So in the same example, what if we get a lease of 1 lakh, cash was involved?
How the cash will involve? Like lease means you will not get cash. You will get some asset to use, which call as right of use of asset. So you will not get cash. You will get some asset. Then when you will get a crane, no cash flow statement is affected. When you pay 10,000, right? Then only your cash flow statement affected. Okay. So operating lease is simple. All operating lease will come under operating cash flow. Exception, if you are using that for some other asset creation, then it is investing cash. Finance lease will convert into two portion: interest portion, principal portion. Interest portion is operating, principal portion is financing. Okay, why numbers moreover we'll learn in lease topic. There you will see how this portion is breaking down. There will apply time value of money, will break down this number, separate lease is there. But here you understand finance lease, interest portion is operating, principal portion is financing. Operating lease, operating. Clear? Any doubts? Okay. Now this is for the renter. For the owner, operating lease is operating inflow. Simple as that. All operating lease is considered as operating inflow because his job is giving the crane for rent. He is using for asset, he is using for his purpose, whatever that is his headache. But my job, give the crane, get monthly rent. So my operation is that. So all operating lease will come under a operating inflow. There are another type of lease called sales type and direct finance lease. Sales type lease means, I'll tell, you gave some asset, you sold an asset, but he's paying in installments, which means he's paying like principal and interest, because whenever you give an installment you also collect interest, right? So that is sales type. Direct financing lease also, you sold but with certain condition. So these types of lease, okay, two categories we have. One is financial institution, one is non-financial institution. Non-financial institution means who? Suppose I am giving a crane. Now I am owner, right? I am giving a crane through a sales type or direct finance lease. I sold. The entire cash will come under operating inflow because my job is to sell the crane. But if I am a bank, my job is not to sell the crane. My job is to give the loan to him to buy the crane. So the interest portion is operating because bank job is what? Give the loan and buy the interest. Interest portion is what? It's operating inflow, and the principal portion is investing. For him, it's an investment. For the bank, giving a loan is investment. And for the bank, interest is operating inflow. So in this, you will understand. See, if it is a manufacturer or a dealer, entire is operating. Interest portion, principal portion, don't worry. For the manufacturer or the crane guy, for the entire portion is operating. But for the bank, principal portion is investing, interest portion is operating. Why? Bank gave the loan. If bank giving a loan, for a bank it is an investment. Okay. So this one you read once again, you will understand in the lessee and lesser point of view. And more about the lease, more about the numbers, how it will affect your balance sheet, asset, liability and income statement we'll learn in the lease topic. Okay. Now, but right now you understood there are two types of lease. One is operating lease and finance lease. Why? What is the condition? There are 5 conditions. We'll learn that. Operating lease, all operating, the cash, whatever people are operating lease, operating cash outflow for renter, and for a lessor, it's an inflow operating. But finance lease, interest portion is operating cash outflow, principal portion, it's a financing outflow. That's it. Now, done with inflow and outflow of operating cash flow. Now we'll go with investing cash flow. Guys, investing activity, inflow or outflow, whatever it is, simple as that. Anything intended to generate future income, profit or cash flow is known as investing activity. Why you will buy a car? To do a delivery, to earn something, and at last you will sell a car, you will earn income. To earn income, to profit, to earn some cash in the intention of doing anything is known as investing activity. It includes making and collecting loans. Suppose if give a loan, investing, then outflow. If I collect a loan, it's like collecting a loan. It's also investing, but it's inflow. Alongside acquiring and disposing of long-lived productive assets like property, plant and equipment, investments in debt and equity securities. You're investing in stock, you're doing an investment in bond. In the name itself is their investing activity. But when you buy outflow, when you sell, inflow. When you buy property, plant and equipment, outflow. When you sell, property, plant and equipment is inflow. Okay. But inventory, there is an exception. Inventory is also asset, but it is not investing activity. Why? Inventory is operating, because inventory is our core operation. That is the reason we will separate the inventory. Okay, that is strictly excluded and it will sit in operating activity. Now we'll see what are the inflow and outflow. Easy. Fixed asset and intangible. Not only fixed asset, even if I buy the intangible asset, it's an investment. Even insurance proceed is also called as inflow. I mean, here I'm not buying, I'm selling. Here we are discussing about the inflow, right? I sold property, plant and equipment. What I'll get? Cash, inflow. I had a building, then it caught fire. I claimed insurance. What I'll get? Cash. So that is also investing activity. Next, investment sales. Like I sold equity, stock. I told, right? Available for sale and held to maturity. Trading, where it will come? If you're invested in the intention of trading security, operating activity. In the intention of available for sale and held to maturity, investment. That's it. Okay. See, trading, exception. You invested in the intention of trading, operating. AFS and HTM, it's investing. Loan collection. You gave a loan, now you are collecting back the loan. Investing activity. Lease receipt. The principal portion, right, of the lease payment collected by financial institution is an investing activity. For them, that is an investment, right? Who? Bank is giving a loan and they are collecting two portion as there. Bank gave 1 lakh, but they will collect 1,10,000. 10,000 is the interest operating activity. Collecting back their own principal portion is investing activity, because the principal I gave, I got my money back. Now inflow we did, outflow direct opposite. Buying a asset and intangible. This includes interest capitalization, asset historical acquisition cost. Interest capitalization means, suppose I am constructing a building. Okay, I would have incurred $1 million to construct this, but I took a loan of 1 million exactly only for this construction of building, not for anything else. But I would have paid like 50,000 of interest. Usually interest is what? Like operating. But here you can put under investing. Why I am paying this interest? Especially to construct this building. So that will come under a investing activity. See, the interest capitalized. So this 50,000 we can capitalize. Here two things we are learning: how to apply in the cash flow statement and how to apply in the balance sheet. So this 50,000 will not go to the income statement. Yesterday we saw that asset acquisition plus installation plus delivery cost we added, right? We will add if there is any interest capitalization, but there are rules in it. I think in the example, in this example you will understand that. Okay, or I'll give the example. One, buying the fixed asset, intangible asset, done. Investment purchase, when you sell the equity and bond, it's inflow. When you buy, outflow. Lending money, you gave money, outflow. Here you are collecting the money, right? Here you are lending the money, outflow. Business acquisition, suppose you are buying some other business, it is also considered as investment, so it is also outflow. See this example: a manufacturer corporation borrow 2 million to build a custom assembly plant. During the construction period, they paid 50,000 in interest. When I paid this 50,000, see the time when they are telling. During the construction period, I paid 50,000 interest, and after the construction, I paid 20,000 interest. Why this difference is, I'll tell. I took a 2 million loan to build this, to construct this building only, but while constructing, I paid 50, and after construction, I paid 20. Now the trick is only 50,000 is capitalized. The condition is the 50,000 construction interest, because this interest is incurred during the construction. The US GAAP required to be capitalized directly into the asset. So it is investing activity. The 20,000, whatever the post construction is there, right? That will be operating. That you can't capitalize. You can capitalize only 50. You can't capitalize the 20. The 20,000 is direct expense. 50,000 will sit in the balance sheet as an asset. Clear? A little bit tricky rule from the US GAAP. It says why not, it applies not only for construction. Suppose any asset in that asset period, right? In the asset purchase period, suppose I'm buying some machine. In the machine is, they are constructing this machine or they are building this machine. At that period, if I'm incurring the interest, capitalize. After that period, building is constructed, but I have not started using it, or still the loan is pending. I have not yet paid the loan. That is not capitalized. Only the construction period is capitalized. Okay. So this example, understand, keep it. Sometimes they will use in the case-based question, trickier one. Not everyone know this rule that much. It is not explicitly provided anywhere. But understanding this US GAAP rule, it is helps. Suppose if these, see in US CMA examination, MCQ question where the student would have answered wrong, right? Suppose 100 members are attending. 90 members have answered the question wrong. 10 members only answered that question correct. That question will have higher weightage in mark. I told the quantity and quality, right? This quality matters. You will get into essay window or case-based question window. Yesterday I told 100 questions in the MCQ, 2 questions in the case-based. To get into case-based, how much question you should correctly out of 50. Quantity-wise you have to put 50. You opened, you went to case-based question and you got a negative result. Might be you would have answered very easy question. Because of that, you attained the 50 quantity wise you got it, but quality wise you have not. Quality means the complicated question. Example, a question where 90 students have marked wrong, only 10 students have marked correct, which means a very complicated question. So it will give you higher mark, 7 marks, 10 marks. If you take one question is have one MCQ will have 3.75 mark, 100 question 375 marks. But this type of question will gain you 7 marks, 8 marks sometimes. So these types of rules and all, which is not that explicit, right? So this type of question you will get, if you mark, you will get more marks by answering one question. But same time, if you attended 49 quality questions but you miss the quantity, you will not get into the case-based question. You failed there only. You got your result there only. No, if you are going to case-based window only, which means you are at least one step ahead. If your case-based question window is not opened, that means you failed there only. So once we click on the finish button after 100th question, you will understand. Once the case-based question window opened, halfway we came. At least next for 1 month I can be okay. We'll wait for the result. If not, that day only got a result, then you can sleep peacefully. I failed. Or else in next 1 month, I failed or passed. Let me start preparing. Suppose one part, if you have given an exam, you will be in a state of mind. If your case-based question is opened, you will be in a state of mind. Do I need to study once again the same part, or do I want to go to another part? That 1 month. If you got failed, I failed. Then I happily sit and study again the same thing. Because the state of mind will be clear. But yeah, it's unfortunately if you fail, two state of mind. It's not cleared. I can study the same thing. I have to sit and study the same thing. So that would be a problem. So quality, quantity, both matters. Okay. So investing activity done, operating done, inflow, outflow. Next, financing activity. Financing activity means easy, simple activity it is. Anything. Financing activity involves used to raise the capital to fund the business or subsequent repayment of servicing the capital. Equity and liability side is there, right? That portion. If an equity and liability, suppose it is a cash effect which you use to raise the capital or settle the capital. If you are raising the fund from the investor, inflow. If you are paying back them, that's it. So which means debt and equity. So inflow means if I issue the equity, that is inflow. Cash proceed from issuing the own stock. And debt issue means cash, loan, bond, mortgage, other short-term and long-term borrowing, inflow. When you settle this, payment of cash dividend or other distribution. Dividend is financing activity. Dividend is financing activity. See, to whom you are paying dividend? To owners. So because of this is not operating. So owners distribution means cash dividend, other distribution to owners is called as cash outflow. Cash dividend. They are clearly mentioning cash dividend. If it is stock dividend, don't worry. It is dividend, but not cash dividend. Next, treasury stock. When you repurchase the stock, it is called as treasury stock. When you repurchase, you have to pay them money, right? So cash payment to reacquire the own share is called as cash outflow. Debt repayment. Here it is not for the owners. Here for the bank. The bank guy came or the bond matured, you paying back. But interest paid on debt, what activity? Operating. That's it. So little bit tricky. The US GAAP told interest paid on debt is financing activity, but interest paid on debt is operating. Why? Because that is because of the operation you took a loan. And equity is financing activity. Dividend paid on this equity is also financing activity. And any borrowing cost. When we issue the debt, right? When we issue the bond, it will incur a cost to pay to the bank. You issue the bond, it means you would have issued for $100, but you would have got only 99. $1 the bank would have taken the commission. That also borrowing cost. So the borrowing cost, penalty and all this comes under cash outflow in financing activity. Finance lease, principal portion. We told, right? Finance lease, interest portion operating. Principal portion is financing activity. That's it. Clear? So here I have mentioned clearly the some few differences which we need to focus, which is trickier one. Dividend paid, what activity? Financing. Dividend received, I mean I invested in some other company, they gave me a dividend, so it is operating. Because here we saw that, right? Where see, inflow, in the inflow, cash received on the dividend is operating, cash paid on the cash paid as a dividend is what activity? Financing activity. Done. Okay, next, stock dividend rule, completely excluded. A stock dividend never reported in statement of cash flow. Don't report anywhere, not even in the no disclosure part also. Okay, it involves distributing additional share rather than cash, because no cash changes, non-cash equity transaction. Okay. Yeah, financing activity, principal portion, financing outflow, interest portion, operating outflow. A company issued 1 million in corporate bond, paying 15,000 debt underwriting issuance fees. Financing activity example, I issued a bond for 1 million, but 15,000 I paid for the bank for facilitating this transaction. 1 million I'll get into my bank account, correct? So that is inflow, financing activity. But 15,000 I paid as a facilitating payment, it's outflow. That also is financing outflow. Now, from year 2 to year 9, I paid 50,000 each year, called as interest. What outflow it is? Operating outflow. And on 10th year, the bond matured. I mean, that 1 million they gave, right? I have to pay back them. What outflow it is? Finance. Financing outflow. So one thing, interest is operating outflow. That you keep in mind. But in IFRS versus US GAAP, there is a difference for these items only. These special items there, right? Other thing, everything is same. Only these items will have a special. We'll go through once. Enough. No need to. Easy. We already know in US GAAP. We just need to know IFRS. IFRS more easier. In US GAAP, one side, IFRS will tell either this or that. We know that IFRS is flexible. So he will tell either you show in operating, either you show in financing. No problem. Tax paid is there, right? In US GAAP, it's operating activity. But in IFRS, it's operating, investing, financing. Which means a profit made on the operation, you pay a tax. That is operating. Sometimes you would have made a profit on investing. You have to pay the tax. Then it's investing. Sometimes on financing, you have to pay on financing. So IFRS allows allocation portion. Tax can be specifically linked to investing, financing transaction. Whatever the transaction it is. Interest received. In US GAAP, operating. But interest, how you will receive? If you invest. Suppose I invested in bond, then they gave me interest. Either you show in operating or investing. They don't have a problem. But whatever you follow, you have to follow that each year. It's not like 1 year you follow this, 1 year you follow that. No. Interest paid, operating. But here it's either operating and financing. See, logically you think it should come under financing. But US GAAP say no, rule says you should show operating. That's it. So under IFRS, it can be operating or financing. Okay. To do a business means it's operating. To obtain some capital means it's financing. But interest paid, sometimes in US GAAP also will put it under investing. When? If the interest is capitalized. That 50,000, 20,000. Dividend received, operating. Here it's operating or investing. Same as interest, dividend also. Next, dividend paid, here it is financing, here it is operating or financing. Okay. So US GAAP is strict, which says everything is operating except dividend paid, which is financing. But IFRS flexible. You have a choice based on the nature of cash transaction. Next. Okay. Now, 3 cash flow we saw. What are the items we know? Now we have to prepare it. To prepare operating cash flow, we have 2 methods I told, direct and indirect. So direct method, more easier approach, which means I'll take my income statement and see each item. Income statement is prepared on cash basis or accrual basis. We use accrual accounting or cash accounting.
So cash flow is always whenever the cash is
Huh.
income statement is
Balance sheet,
it
everything.
equals to
Yeah, but here, instead of what I told you, cash involves or we don't. Especially we gave a note telling that in US GAAP we never ever touch the cash basis. Event occur, done. Obligation done. So keep this in mind. It's accrual basis of accounting in the entire US GAAP. Okay. So the income statement is prepared on accrual basis, but cash flow statement is prepared on cash basis. Here I want only cash involved, but sales if you take, does that mean entire sales is cash? No. So like this, each item, revenue, cost of goods sold, everything I'll go and convert into cash. Revenue I'll convert into cash received from customer. Okay. Cost of goods sold I'll convert into cash paid to supplier. What is the cash I paid exactly this year? What is the cash I paid to the customer this year? That I'll come to know by using the direct method. Indirect method, different. Here direct method will create a separate thing starting from cash received from customer, cash paid to supplier, like this. Indirect method, what it does, it take net income and put in first line, then it adjusts it, plus minus will adjust it. Okay, that is when non-cash item it will remove, and cash received from will adjust this, keep on adjusting, we'll see. So but both will come, final answer is same. If you use indirect method, direct method, see in here it is a MCQ, whichever, if you have a data for direct method and indirect method, whichever is easy you do it, but sometimes there will be, you don't have a sufficient data to do it. So in that time, whatever the question demand us to do, that you have to do and get the answer. The ICMA, that certified management accountant, explicitly required candidate to prepare using the indirect method. Sometimes if in the case based question, if they ask, they might ask indirect method to calculate and present it. So as a result, the indirect method is primary focus, while the direct method conceptually they can test. So direct method list individual specific activity, cash spent or received, income statement alignment. We'll take an income statement and we'll do this. See, it's outside the scope of exam. Which one? A step-by-step mathematical creation of a direct method is outside the scope of exam. So no need to worry about it. But a base, now you know what is inflow, what is outflow, done. That's it. If you know inflow and outflow, you already created your, you already conceptually will be able to create the direct method. How it is created is adjusting accrual items to cash flow. Income statement is prepared on accrual method, right? That you have to adjust into cash flow. One example we'll see. Revenue we take. Revenue is equal to cash? Yes, no? Is all the sales is cash? No. So now this revenue we need to convert into cash received from customer. How to convert this is, cash received from customer is equal to, beginning I might be having some account receivable. That means in the beginning of the year, my customers need to pay me 1 lakh. This year they purchased for 5 lakh. So now total how much my customer have to pay me? 6 lakh. But ending, they left with 2 lakh more. That means how much I would have collected? 4 lakh. That's it. This is your cash collected from customer. See, my revenue is how much? 5. But I collected only 4. See, now the revenue got converted into cash collected from customer. So cash received from customer is equal to revenue plus beginning. You put like this, e.g. beginning someone want to give me 1 lakh. This year you took an item for 5 lakh. Now total how much you have to give me? 6. More you have to give me 2 lakh more. That means you would have paid me 4. So that's it. Now the cost of goods sold are adjusted both in inventory and account payable to calculate cash paid to supplier. Same we do for payables also, which means beginning I had an outstanding of 1 lakh to pay. This year I purchased for 4 lakh. This year I purchased for 4 lakh. More I have to pay him 50,000. Then how much I would have paid? 4 lakh 50 is paid. This is outflow. Like this, the cost of goods sold is converted into cash paid to supplier. Okay. One is this, adjusting accrual item to cash flow. When you take this accrual item, you convert into cash flow. Clear? Easy as this direct method. Next, eliminate non-cash revenue and expense. What is this non-cash revenue and expenses? Some revenue you would have earned or some expenses which is non-cash expense. One big example of non-cash expense is depreciation expense. When there is a depreciation, do you actually pay cash? Depreciation is a non-cash expense, we all know. So that expense would have reduced your income, right? That expense would have reduced your income. That item you have to eliminate. You don't even consider that. In indirect method, we use opposite way. But in a direct method, you take only what you require. But you are not starting from net income. You are taking fresh book and you are preparing what you want, what I want, what I don't want. Converting first, what you have to do, any accrual you have to convert into cash. Second, any item which is non-cash, don't take, ignore it. Which means any item income statement that doesn't involve actual cash, don't report. Selling expense, example, bad debt. Does bad debt involve cash? No, it doesn't involve cash. So that is considered as non-cash expense. Interest expense. Sometimes interest expense is non-cash. I'll tell you how it is. Like this. It is called as amortization of a bond discount. I would have taken a loan of 950. I taken a loan for 950. And I told after 2 years, I'll pay you 1000. When I am paying? After 2 years. But the rule is, you have to, we know that expense rule, whenever the time period over, you have to recognize the expense. So after 1 year is 50, after next year it is 50. This 50 I would have recorded as expense, interest expense. But the question is, like, did I pay this? No. I am paying total 50, sorry, not 50, 50. Sorry, 25, 25. Okay. First year it is 25. Second year it is 25. I am paying 25 on the first year. I told you, give 950. I'll come back after 2 years and I'll pay you 1000. 1 year is done. When 1 year is done, according to expense recognition, what we have to do? We have to recognize the expense, like a prepaid insurance and all we recognize, right? So according to that, we have to recognize, yes, I am now liable to pay him 25. So I'll record expense. But did I paid actually cash? No. So those items, ignore. Income tax expense. Sometimes current payable, deferred tax account, ignore it. Income tax expense means, suppose I would have not paid it. Expense occurred, but not yet paid. Those items eliminate. Sometimes this interest expense, interest income will be also. I gave someone 950 and he told he will give me 1000. But after 1 year, I earned 25, but I have not received. So those income I have to eliminate. Okay. When done, first accrual to cash, 2, eliminate non-cash item. 3, remove non-operating gains and loss. Any gains and loss which is not related to operating, remove it. One example, 2000 rupees was the delivery van. I sold for 2500. What is the profit I earned? Where you will report this profit? income statement. But is this related to operating? No. So remove it. Don't get. This one will go where? Investing activity. So gains and loss, such as gain and loss on sale of fixed asset or non-trading investment, are included in net income, but they come from investment or financing activity. So the total cash proceed from fixed asset sale, it's include gain and loss, so that you will report in investing activity. So remove the gain and loss from the operating and put it in investing activity. Okay, clear with this? So done with non-operating gains and loss. You see the this different example. Clear with this? 3 items. What and all 3 items we did? First, adjust the accrual, eliminate non-cash revenue and expense, and eliminate non-operating. Non-operating, if even it is a cash, but it is not related to operating, remove it. That's it. You see this example. Business record 1,500,000 in sales. This is an example of accrual to cash. Beginning, they want to give me 1 lakh. So total, how much they have to give now? 16 lakh. Okay. Ending, 1,25,000 is pending. So how much they would have given? 14 lakh. 75,000 they would have given. Okay. In 15 lakh, this year I gave 15. Beginning I gave 1. So total you have to give me 16. Now you have to give me 14 lakh 75 means you have to give me more 1 lakh 25 means you would have paid 14 lakh 75,000. So you will write only cash collection. This is direct method. Direct method easy as that. Do 3 simple things. Remove non-cash item, remove non-operating item, convert income statement from accrual to cash. How I did this. Okay. Now in indirect method, it's more complicated if you want to tell compared to direct, but this way you will understand properly. So indirect method start from net income, then we keep on adjust and we'll convert net income to income cash flow from operating activities. We have first line will be net income. Okay, last line will be cash flow from operating activities. So this journey from net income to cash flow from operating activities, what and all we are going to do, we'll see. Okay, so we call this as a reconciliation method. Reconciliation is done like this only. From one place to another place, we'll do some adjustments, then we'll bring at other place. That is called as reconciliation, which start from net income. So the ICMA require candidates able to prepare the operating section. They are telling you should. I will ask. So this is highly tested area. So start with net income, apply 4 specific type of adjustment, and reverse non-cash item, remove non-operating item, and account for working capital. I'll tell this what and all. Okay. So same what we did in direct, we'll do in an indirect method also, but in a different manner. First, reverse non-cash items. Now in the income, if I take the income statement, assume that in the income statement, I have reported 1 million profit. Okay. In this cash item is there, non-cash item is there, many items are there. So what I have to do first, reverse that. Add the expense. Usually what will do the expense? Minus, right? But here, add. Why we are adding is, in the net income got reduced because of this expense. Because of the depreciation, what happened? My net income went down. Example, my depreciation was 50,000. Because of the depreciation, my net income goes down by 50,000. But did I lose 50,000 cash? No. So I have minus there, right? Here what I'll do, non-cash or depreciation expense, I'll add 50,000. Because depreciation is a non-cash expense. Same amortization is also non-cash expense. See the examples now, and when you practice more, you'll work on it. Okay. Impairment loss. Impairment loss means, impairment recognition, we have a topic, but impairment loss means A reduction in value of asset is called as impairment. Example, I had a building, 10 lakh worth the value was, because of market reason, now the building value is 8 lakh. You have to recognize. So I will write 2 lakh loss. But I have not sold the building yet. So did I lose 2 lakh in a cash? No. But have I reported it on the income statement? I have reported on the income statement. Now I have to reverse it. Suppose I have lost anything, I reverse. Next, bond discount amortization. Bond discount amortization is it's a reduction in your income. It's a reduction in your income because these reduced net income without a cash outflow must be added back. What is this bond discount amortization is? I told about that 950 and 1000 investment, right? Same way, I have invested, but like a non-cash expense it is. That only from 950 to 1000, I would have recorded 25 minus. In the income statement, I have to record it. But did I pay the cash? No. So that one. So these items, what you have to do? Add back. See, expenses, what and all you minus, do you add back? Next, deduct revenues and gains. They're telling to do the opposite here. Usually revenues and gains, what you will do? But they are telling you to deduct. Why? Because those revenues and gains are not related to cash. It might be like few revenue. In the opposite of this only you think. In the investor point of view, think. I invested 950. After 1 year, I earned 25. But I have not received the $25 in my bank account. But in the income statement, I would have written 25 I got. So that is a non-cash gain. Non-cash gain. So I have to deduct like amortization of bond premium and undistributed earning of equity method investment and unrealized investment holding. Few unrealized investment holding. Equity method investment is a different type of investment again, where you will record the income, but you would have not received the cash. Understand? Deduct revenues and gain, which is non-cash. Okay, it says that only, right? Non-cash. Unrealized market gain and loss. Unrealized gain and loss. If you have deducted, add back. If you have added, deduct. Unrealized gain and loss, which means you have not received a cash yet, but you would have realized it, that telling this much. So that unrealized gain and loss must be deducted. Gains must be deducted and loss must be added back. So these things you do to adjust the net income. First thing, understood what is the first criteria? Reverse non-cash item. You take the income statement, see what and all is a non-cash item, reverse it. 1. Eliminate investing and financing activity. Anything which is related to investment and financing activity, you have to eliminate it. Because we saw what and all comes under financing and investing activity, those items, if you see in the income statement, remove it. Example, gain on sale of equipment. You sold equipment, you have received cash, but it is not related to operating. Remove. Loss, add back. If it is gain, deduct. Loss, add back. Because that gain was never an operating. That loss was never an operating. Suppose I gained 5,000. What I have to do here? Minus 5,000. I added in the income statement, here I'll minus. Done. Third one, individual account adjustment. Individual account adjustment means it arises because of the timing difference when revenue and expense recognized and actual cash moves. Revenue and expense I have recognized and actual cash when I came. Accrual method and cash method. Revenue and expense happened sometime and I paid a cash sometime. That one. This involves monitoring in current operating asset and liability. Here, no one will come and tell this much cash collected, this much, this. You have to go and see the balance sheet and income statement and find this. Okay. How to find this, we'll tell you. Before that, we'll see this example. A business launch on 30 December. The only transaction is what? They purchased for $100 of inventory. No any other transaction, only $100 of inventory purchased. I'm telling only purchased but not paid. So actual net income is zero. No expense, no income zero. Balance sheet, inventory increased by 100, accounts payable 100, tally, liability and asset. No, net income, increase in inventory 100, increase in payable 100, so the net cash flow is zero. I mean, I have not yet paid them. So here how they have adjusted is take the net income minus the inventory, add the account payable. Why? You see this table will understand, may like help you to understand this. When you have to add in the net income, when you have to minus in the net income. You took the net income, right? We are adjusting this. When you have to add, when you have to minus. You go and check the balance sheet part now. To do this, where you will go, you will not check in income statement only. You will go and check the cash collected from customer, cash paid to the supplier, right? That is direct method. Here no line called cash collected from customer, paid to supplier. Here we are playing with account receivable. Your cash collected will come. Inventories, it adjusts your cost of goods sold. And accounts payable, cash paid to supplier. Okay. So first receivable. If receivable increase, that means you collected more or you collected less. Yet no, I'm not telling yet to collect. Past, because based on the past we are preparing, right? My receivable increased, which means I collected more or I collected less. My receivable increased. I mean, someone has to give me 1 lakh. Okay, beginning was 1 lakh. My ending is 2 lakh, which means I collected more. I collected zero, right? Example, my beginning receivable was 1 lakh. My ending receivable is 2 lakh. Okay, my sales was, my ending is 2, my sales was 3 lakh. Okay, then how much I would have collected? So beginning plus sales minus cash collected from customer is equal to ending. I'm reversing that formula. Okay, so 4 lakh minus 2 lakh will be 2 lakh ending receivable. I mean, you have to give me 1 lakh. I gave again 3 lakhs of goods. Now total how much you have to give me? 4 lakh. But more 2 lakh is pending. That means how much you would have paid me? 2. So it's more I have collected or lesser I have collected? Less. When the receivable increase means you have collected less. When you collect less, you are not getting a cash, which means in net income 3 lakh would have affected. In the net income, how much is effect is there? 3 lakh effect is there, but actually you collected 1 lakh less because your receivable got increased by, no, your receivable got increased to, but increased by 1 lakh. That 1 lakh you should minus or plus here. Tell me what you will do. You will minus 1 lakh because you collected less. If you collect less, you should not show in the income. I mean, you should not show in the net income as per the cash flow statement. So you'll minus, which means when account receivable increase, that too you have to take net. Okay, when account receivable increase, you subtract, which means the revenue were recognized on credit, but cash was not collected. That is the reason you reduce. Next, account receivable decrease, went down, which means you collected more than the sales. Example, we'll take another example. My beginning receivable was 50. I sold for, I did a sales, credit sales for 2 lakh. My ending is 2,25,000. Sorry, my ending is 25,000. Then how much I would have collected? 2,25,000. So not only I collected this year sales, I collected old 25,000 also. So more than the sales I have collected, which means more cash came in than my income. So what I'll do, I'll add 25,000. Because I collected more, how much? 25,000. So the difference is 25. Okay, clear with this? So here cash collection exceeded than the old receivable. So old receivable got cleared. So cash collected were exceeded than the sales, which means old receivables got cleared. That means you got more cash than the sales. If you get more cash, add it. Okay. Same opposite will be the payable. Same ulta, direct opposite is the payable. Which means if payable increase, means you paid more or you paid less. Payable increase, less. Because I have to give you 1 lakh. I used more 2 lakh. And the ending, I have 2 lakh pending, which means I paid only 1 lakh. So because I paid less, that I have to add. When I paid less, I would have recorded expense. But as I paid less, what I'll do? That I would have minused in the income. Now I have to add back. So payable, if I would have paid more, it would have decreased. I want to give someone 1 lakh. Now the ending balance is just 50. I paid this year expense also I paid. Plus I paid more 50, which made me decrease in payable, which I have to subtract. Clear with the payable? Clear with the receivable? Inventory and receivable works as same. Inventory increase means subtract. Why I have to subtract is because we spend more cash to buy inventory which have not been expensed through COGS. Okay, like same as a receivable. When I purchase inventory, where it will go and sit? It will sit in the balance sheet. But we told this is excluded from investing activity. I told explicitly, I written separate line, inventories are excluded from investing activity. So it should show however in the operating activity. So when inventory increase means my investment increased. In the Godon I had 10 chairs, now I have 100 chairs, which means I would have paid for 100 chairs. Then it will get effect in the payable, don't worry. But my inventory increased, so my investment increased. Investment increase means what? My outflow increased. So when inventory increased, subtract. When inventory decreased, add. I had 100 chairs, now I'm having only 10 chairs, which means 90 chairs I sold. 90 chairs I sold. If I do a sales of 90 chairs, I would have received cash, or I would have somehow I got account receivable. Then we'll play with account receivable, don't worry. But if investments are going down, my inventory went down, investment will go down. If investment is going down means what? I'm selling more, so then I will have inflow, so I'll add. So in receivables and inventory, same manner they will work. Payable will work in the opposite manner, which means this is called as working capital. So the asset increase minus, asset decrease plus, liability increase plus, liability decrease minus. Asset increase means investment increase, so minus. Asset decrease means investment decrease, so plus, because investment go down, I'll get a cash. Liability increase means I would have not paid, so I can increase my cash because I have not paid the cash, so I can increase my net income. Liability decrease means I paid more than the expense, so my cash will go down. So liability decrease, subtract. So this is called as individual account adjustment. So 3 things. First, reverse non-cash items, eliminate investing and financing activity, individual account adjustments will do. Okay. See, this is another cheat code. Increase in liability, add. Decrease in operating asset, asset decrease, add. Increase in operating asset, subtract. Decrease in current liability, subtract. Non-cash loss and expenses included in net income. If it is non-cash expense and loss means add. Non-cash, which means you keep in mind as a depreciation. It was a non-cash, right? But I would have minus there, so I will add here. Loss and expense whose cash effects are related to investing and financing. Loss and expense exclude But here you can't exclude. Here we are taking income statement, right? So in direct method you can eliminate, but here you have to do something with that, either minus or plus. So it was loss and expenses related to investing and financing. So I will add back because I would have minus in the income statement.
Already minus, so now you're
Adding back. In direct method, it's about taking a paper, selecting. Indirect method, you copy pasting that, removing and adding back. Direct method, that is, I told easy. You can take, I want this, I don't want this, I want this, I don't want this. But in the indirect method, you take that and you start scratching it. Either you have to touch it, either you want or you don't want, you have to touch it. Tell, okay, I don't want this, I want this. You have to scratch it. At least whatever you minus, you add. Whatever you added, you minus. Next, non-cash gain. You would have added, no minus. Gain and revenue, which is related to investing and financing, you would have added, no minus. So this, like you can consider as a cheat code. So if you understand this, keep this in mind, you can apply that in the indirect cash flow. Clear with this? Okay. And this is a separate, I mean, this is related to operating cash flow only, which we call as bond discount premium adjustment under indirect method. I'll explain this with an example. Suppose as a bond issuer, you think bond issuer means a person who's taking a loan. Okay. Sometimes I'll issue a bond for $1,000. Okay, I issue, no, we'll take 1,000 as a par value. Sometime issue a bond for 950 and I'll pay back them 1,000. Sometime I issue a bond for 1,050 but I pay back them 1,000. There are multiple reasons to do so. Because of market demand and something, we'll do this. You don't tell why we'll pay extra. Yes, they will pay. We'll learn that in part 2 why they are paying. Okay, but now understand this as a issuer, not as an investor. Issuer means you are taking a loan. So you took a loan of 950 in first case and you will pay back them how much? 1,000, which means you pay more. Here 1,050 you get, but you pay back them how much? 1,000. In between this, we are paying them interest also. Normal interest they will pay. That don't worry. That you know already, it will sit in the operating cash flow. Leave that. Ignore that. Keep that there only. But this one, 950 to 1,000 or 1,050 to 1,000 is called as amortization of a premium and amortization of a discount. Here we call this as bond discount amortization. I mean, as an investor, right? No, as a bond issuer, discount amortization we are doing. Discount amortization means this one we sold in discount, right? And we are paying 1,000. So yearly what we'll do, I think we consider this as a 5 years. We keep on adding 10, 10, 10, 10, 10. Then at last how much it became? 1,000. See, in liability we'll write 950. Each year we'll write 10, 10, 10, 10, 10. Then at last after 5 years, how much is the liability value now? You have to pay how much now? 1,000. So this 10, 10, 10, 10 each year you are doing, right? This is called as amortization of a discount. Discount was there, you are amortizing each year and making it as 1,000. So this 10, 10, 10, 10, 10 is a expense, right? But you're not actually paying a cash each year. Are you paying a cash each year? No. This 10, 10, 10, 10 would have increased your expense. No, you decrease it. So in this case, what you will do? You minus in the cash flow statement. Okay.
10 will increase our liability, right?
Liability it will increase. It will increase our expense also. How the liability is increasing? Because of the expense. Double entry. Liability increase one side you told. What is the other entry? Outstanding loan or outstanding interest expense you tell. But interest expense increased, which reduced my income. But no, like which I would have reduced my income. Now I have to add back. Add back in the net income. This one is opposite. Amortization of a premium we call. 1,050 he gave, but I'm paying back how much to you? 1,000. Thus, what I'll do? I'll minus 10, 10, 10, 10, 10 from where? Income statement. I'll reduce from my interest expense this. Okay, but you're paying him separate interest, but I'm reducing this. Consider this as in income and I'm reducing. But you're actually getting 10, 10, 10, 10 each year? No, he gave 1050 at first. I agreed with it. But are you getting 10, 10, 10 each year? But you are recording in the income statement as revenue. So you have to minus this. This in the point of view of issuer. In the point of view of investor, do the opposite way. Where if I would have invested 950, how much I'll get? 1000. Which means I will record each year 10, 10, 10, 10, 10 as income. But am I getting actually 10, 10, 10, 10 each year? No. So I'll minus this. Next, 1050 I paid, but he told he will give only 1000. And I'm recording minus 10. I will not get 10, I will not get 10, I will not get 10 each year. Yes, you are not getting 50, agreed. But are you not getting 10, 10, 10, 10 each year? No. At last you are not getting. Then you worry about at last in the investing activity. Don't worry in the operating activity. So I would have minused this in the income statement. Now I will add this. That's it with this special bond discount and premium adjustment. Okay. Bond discount amortization means it gradually increases the net carrying value from 950 to 1000. Bond premium means it gradually decrease the carrying value from 1050 to 1000. If you are an investor, amortizing discount means it increase the interest income, which you have to minus. Amortizing a premium means it decrease. Premium amortization means it decreasing your interest income, so you add. Do the opposite to the borrower, like issuer. Discount amortization means your expense is increasing, which means you would have minused, you add back. And premium means you would have decreased your expense, so you deduct. Clear? This is an example. Okay, a company had an outstanding liability during the year. Its cash interest payment is 60,000. They paid actual cash interest payment is how much? 60. And due to amortization of bond discount, they recorded 4,000 as interest expense. As an issuer, amortization of discount means it's an expense. See, the names are a bit confusing for issuer, so go back once again. If you want to watch a video or you read a textbook once, so it will get in a mind. So amortization of a discount means discount amortization means expense got increased. Actually they paid 60,000 cash, 4,000 they recorded as interest expense. So total how much they would have minus from the income statement? 64. 60 in a cash, 4 in amortization of discount. But actually how much you paid cash? 60. Don't worry about 60. 4,000 is expense, but it is a non-cash expense. So we start with net income and we add 4,000 because we minused it. So we add it. If it is amortization of premium means what you would have done is 60 you would have given and you would have minused 2,000. So we would have written I gave only 58, but you actually gave how much? You actually gave 60. So then you add back 2,000. Now 58 plus 2, it became 60. This is in the point of view of amortization of premium. Okay. 3 things is done. A last thing is trading security. I told that 3 types of investment, right? Held to maturity, available for sale, trading security. Held to maturity, available for sale, investing activity. Trading security will operating activity. So if he is a broker or dealer, 100% it is operating activity. But non-trading companies, which means a person who is not doing a trading in the stock market, right? For them either it is operating or investing based on their intention, based on their judgment. You can tell. If you can tell operating, we can tell investing. But for security trading firm, 100% trading, because their job is to do this selling and buying of stock. How to do this? Like how to report this is called as operating activity, right? In income statement, you'll write only gain on sale of trading account. I bought something for 1,000 and I sold for 1,050. How much you'll record in the income statement? You'll record entire 1050 or you record only 50? Only 50, right? We write gain on trading security. How much? $50 you'll plus. Agreed. You should put in the income statement only. But here what you have to do is strip out the realized gain. First, what you do, whatever the gain and loss you do, you minus. So in the point of view of gain, what I'll do, I'll first minus this 50. First, I'll minus this 50. And how much actual cash I got because of the trading security? Because we consider trading as operating activity. So any purchase in trading security and any sales from the trading security is cash inflow and outflow. So account for gross cash flow. Instead of leaving the transaction out on operating section, the entire cash from the sales is operating cash flow. Got it?
Already you have added 50. The cash flow you'll be adding
entire 1050. So you have to minus that 50, so we can enter 1050. So trading security can be either debt or equity, sold or near term. The plan to sell the near term. The primary purpose is to buying and selling to short term profit. So anything comes under this criteria is considered as trading security. So buying and selling of trading security is considered as operating cash flow. Okay. Cash outflow from purchase must be included separate adjustment in the operating activity. Suppose I purchase trading security means it's outflow. Realized on gain included in net income, first minus. Realized on loss, you would have minused in, so you add back. Then cash proceed from the sale. You sold for 1050, right? Income statement I would have not written 1050. You directly add 1050 in the cash flow. And cash paid for the purchase. In income statement you would have not written, but you're directly minus. Like how in the investing activity we'll do exactly in the operating activity for trading securities. Okay. This example, net income I earned. We'll prepare this and we'll go for a break and then we'll start investing and financing activity. Okay, we'll prepare the operating activities income statement now. Yeah, if you write down this and we'll try to prepare. Yeah, net income 250. Now we'll adjust all these four things. We'll do depreciation expense 35,000. Okay, gain on sale of equipment 12,000. Gain, how much gain I earned? 12,000, but I sold for 45,000. Realized loss on trading security. Doing a trading security, I lost 5,000. Management classify this as trading securities or operating cash flow. They are telling this is not available for sale or held to maturity. This is trading. So where it will go? Operating. Gross cash paid for new trading security. We paid 22,000 and bought new trading security. Gross cash received from selling the trading security. I sold trading security and got 18,000. Now, net account receivable increased by 15, inventory decreased by 8, payable increased by 10. Clear? Is it visible? So, payable increased by 10. From net income till here it is there. Now, we'll have four things we learned. Eliminate non-cash, eliminate non-operating item, which means investing and financing item, and each account item, which means payables, receivables, inventories. Then we have for trading securities. Okay. Start from net income, then add and minus, do the reconciliation, plus or minus the adjustments. Let's see. And try and tell me the answer, how much you're getting. I mean, if you want, you can do directly in a calculator, which you want to add, which you want to minus, rather than writing. Humaira, you also try once. What's the answer you got? 3 lakh? 3 lakh 22. Okay, more than the net income. What about you? You did not get only. How much? Like, at least you do addition and subtraction. Okay, we'll start from net income. So what we did with the net income? First we'll start with net income. We'll take the net income and we'll apply directly. Net income you took. Next, what is the first line we had? Depreciation expense. What we have to do? Depreciation expense, add back, because it was an expense we would have minus. Here you have to add back. Okay, so I'll do all simultaneously. So 250 plus 35,000. Next, gain on sale of equipment. Gain I would have added in the income statement here, because this was not related to operating activity, so I will minus. And they have given 45,000, right? This figure can be used in investing activity. Now we'll do only operating, so done. Okay, this 12,000 is a gain on sale of equipment. That what we have to do? We have to minus. Next, realized loss on trading security. We lost 5,000. Yes, it was related to operating activity only. But we know that if we have a realized loss and cash received from trading security, this both will go. I mean, I purchased some trading security and sold for 18,000 and I made a loss of 5,000. Now, how much actually did I get a cash? Huh? No, like actually how much I got a cash?
18.
I got 18, so I'll add 18 first. Okay, and I minus this 5,000 and I minus this 5,000 in the income because it was a loss, right? Now I'll do? I'll add back this 5,000. Okay, see, realized loss, remove on non-cash loss. We added 5,000 and we added 18,000, because if it is a loss, we told, right, realized loss on sale is included in the income, so we add back. So we added 5,000 and we also add 18,000 because we have received 18,000. And also cash paid for new trading securities minus 22,000 we paid for trading. If it is available for sale and held to maturity, ignore. Done. Next, this is also done. This is also done. Okay. Now, account receivable increased. Add or minus? And inventory decreased by 8,000. Payable increased by 10,000. So answer is 277. So why you got like 300?
Actually, I have added 45,000.
Okay.
It should come under the
Investing. The equipment was sold for 45,000. So this is how the exam confuse you. The 45,000, yes, we consider in the operating cash flow, but not, sorry, we consider in the cash flow statement, but not in the operating cash flow. So this 45,000 you will report in investing, because we'll directly write, I received 45,000 from the sale of equipment. So this is the answer. See the answer here. So you'll get 277 after doing everything. Clear? Any doubts on this? Okay. And can you try this one? Try this example. Beginning retained earning was 2 lakh. Ending retained earning was 3 lakh 50. Beginning, ending. Dividend declared was 60. What was the net income during the period? Sometimes they will not give this net income. They will give this information and leave. Okay, in that point, they will not give income statement only. They will give this information and they will tell to calculate operating cash flow. But we can't find operating cash flow from this example, but we can find what? Net income. So try net income. Today morning only we learned, right, how to find the net income. We do have a formula, or you use that formula and try this. Beginning and ending. The difference between beginning and ending, 2,10,000. No. See, what was my beginning retained earnings? What is my ending retained earnings? 3,50,000, right? And how much I paid a dividend? So now one thing is sure, that I earned 150 in a profit, because initially was 2 lakh, and also it is more, the difference between this and this is what, 150. One thing for sure, I made 150 plus I gave 60,000. From where I got that 60? From the profit, right? So I would have earned 210. Now minus this, beginning plus profit minus dividend, 210. Yes. So the formula today morning we learned, right? Beginning retained earnings plus profit minus dividend is equal to ending retained earnings. So we have everything. We want profit, right? It's not every time they will ask ending. We have beginning and ending. We have. So 2 lakh minus 60,000, it should be how much? 1 lakh 40. But we have 3 lakh 50. Then how much we would have earned? 2 lakh 10. See the difference between 1 lakh 40 and 3 lakh 50? To find the difference every time, we have to do subtraction. See, 2 lakh minus 60,000, how much it is? 1 lakh 40,000. But we have 2 lakh 3 lakh 50. Why? Because of the profit. So what is the difference between 1 lakh 40 and 3 lakh 50? 2 lakh 10. So that 2 lakh 10 you earned from the profit. Okay. Now 210 plus 200 is 410. 410 minus 60, 350. Beginning plus profit minus dividend is equal to ending. Clear? It's, as I told you, not every time they will give a same, how exactly in the formula. Sometimes they might add dividend, sometimes they might ask beginning, sometimes they might ask ending, whatever. Okay, clear with this, clear with the formula? Okay, we'll take a break. We covered operating cash flow. After a break, we'll cover financing and investing and financing. Nothing we already did, but we'll do this theory one, and we'll prepare finance cash flow statement. Then we are done with cash flow statement. Like we now prepared investing cash, like operating cash flow. We'll investing and financing thing, add and minus, investment part, finance part. Then we create a complete cash flow and done with the cash flow statement. Okay.
And
Your name?
Sri.
Do you have your APID something? No. Can you didn't tell him?
I mean, today morning
Then I think you'll be not able to. Because you should be having this student ID or something like. Because once you scan this, you will get. You have to enter your student ID. First thing.
So today we'll share the PDF of the class.
I'll share this. Done with this? We will start with this investing. Done with operating activities. Any doubts in the operating activities? Clear? So one thing is like this special items called as bond premium, amortization of bond premium, amortization of bond discount on bonds. Those things. You just go through that once again. You'll be able to catch it. Okay, done with financing activity, like operating activity, we calculated operating activity, we kept aside. Next, it is investing and financing activity. We know what are the items we have. It says no netting allowed. You can't net outflow into it. Outflow separate, inflow separate, you have to present. Cash paid to purchase equipment and cash received from the sale of equipment, you have to show in separate line. Okay. Exam question frequently require candidate to solve the missing cash amount from the fixed asset sale, okay, by giving other information using this book value, like cash received from the sale. Example, I sold an asset, which had a book value of $100,000. I sold an asset which had a book value of $100,000. Incurred loss of incurred loss of 30,000. Okay. So it said I sold an asset which had a book value of 100,000 and in the sales I incurred a loss of 30,000. Then how much cash I would have received? 70,000, because the value of this asset was 1 lakh, but I incurred 30,000 less, which means I have sold for 70,000. So I have received cash for 70,000. By using only this information, we have to understand, find this. Now, the historical cost or initial cost of the asset was 1 lakh, and accumulated depreciation till today, we depreciated this for 60,000, and we sold this asset for 50,000. Okay, we sold this asset for 50,000. What is the profit or loss we made? Gain 10,000, because historical cost minus accumulated depreciation will give you book value. The value of the asset was 40, but I sold for 50, which means I gained 10,000 profit. Also, I received 50,000 cash. I mean, two information, 50,000. Now, where? Yes, you see this? Book value is equal to original cost minus accumulated depreciation. You will get book value. Cash received is equal to book value plus or minus, plus gain or minus the loss. Okay. Example, cost was 20. Accumulated depreciation was 12. Then the book value is how much? 8. But on the sale, I gained 5,000. Then I have sold for 13. Because the value of this asset was 8,000. And upon this 8,000, I got 5,000 as a profit. Then how much I would have received total in cash? 13,000. Suppose if it is loss on sale, that means this asset value was 8, but I lost 5,000. Then how much I would have received cash? 3,000. So from the book value, you can find this. Okay. So in the cash flow statement, in investing activity, will you write 5, 8 or 13? How much you will write? Direct 13. No need to show separate gain, because in 13 gain is already there, and in 3 already we have subtracted the loss. So no need to again subtract, no need to add again the gain. But we have to do this in the operating cash flow. Investing cash flow, I sold for 10,010. Don't worry about loss or gain. But we require loss or gain just to calculate how much cash we received by using this formula. Okay. Then that's it. Then we have few non-investing and financing activities. Few non-cash investing and financing activities that also we need to report in the statement of cash flow disclose. I mean, not in the statement of cash flow, but statement of cash flow disclosure, like a note. Okay, they never show on the face of statement of cash flow. Instead, they must be disclosed in separate schedule at the bottom of the statement. You have to show separately. What are these non-cash items? Converting outstanding debt into equity. You had debt. I mean, I want to give a person 5 lakh, which is a financing activity, which I have not given. What I did, I converted that 5 lakh person into my owner. He became a shareholder. Did I give cash anything to him? No. But there was a transaction. What happened here? Debt decreased, equity increased. Non-cash activity, so we'll disclose. Next, capitalizing the right of use of asset in exchange for lease liability. Under lease, we'll learn this, which means we took a asset for lease. Then what we'll do, we'll write under asset side right of use of asset, and liability side lease liability. So asset and liability is tally, then we'll keep on writing down and make it 0. That is the story of lease. We'll write it full amount, then we'll try to make it till 0. That's lease. But it is also non-cash activity, because initially we just write it. Purchased of fixed asset. Financed directly by the seller via direct lender. I mean, we'll buy a car and a loan, right? So when we buy a car and a loan, will bank give us a money? Will bank give money to us? When you're going to buy a car, you'll go to the showroom, car, bike or home or anything. You go to the showroom and you will tell, I want car or I want bike. Then what you'll do? Assume that the down payment is 0. You took a car for 10 lakh and entire 10 lakh is given by bank. Like the bank is giving the loan. Are you receiving in 10 lakh into your bank account? No. You are getting an asset, investing activity. But in the investing activity, is cash is going out? No. So you can't write under investing activity. Yes, you bought a car. Is cash went out? No. And your financing activity? No. Why it's not financing activity? Because you have not received any cash. So direct like an investing, non-cash financing and investing activity. This is not reported in the cash flow statement. Why? Because no cash came or no cash went. Okay. Acquiring and selling property in exchange for, then it will come. No, interest portion will be operating, principal portion will be yes, principal portion will be investing activity. It can't be financing activity. Why? Because we have not recorded inflow, so we will not record outflow also. Okay. Acquiring or selling property in exchange for stock or non-cash asset. Same. We bought a car but in return of that we gave our company stock, or in return of that we paid through non-cash item. We gave our company furniture, something we gave, but not cash. Okay. Receiving a building or asset as a gift. Suppose we received some asset, but as a gift. So non-cash related. So this will not go in your face of the cash flow statement, but it will separately, we have to disclose this much asset we invested. This is a financing activity we had, but it is related to non-cash. Suppose if we report this, our item in the cash and cash equivalent will be wrong. That is the reason we'll not report this. Okay. And required supplementary disclosure. What is required? Company must disclose their criteria for determining short-term investment qualifying as cash equivalents. You have to disclose what is the cash equivalent according to your company. That you have to disclose. You set some policy. This investment will be cash equivalents. If the policy change, it treated as change in accounting principle. Today morning we saw change in accounting principle. Retrospectively we have to change. So it's require a retrospective restatement for the prior presented. Next, cash interest and income tax paid. We have to disclose this separately. In direct method we'll disclose it, because in direct method what you will do, you take income statement, you take each item and report it. But in indirect method it is not done like that. We'll start from net income and we'll keep on adjusting, right? What and all is not required, we keep on removing from that. In indirect method, cash paid for interest and cash paid on income tax are hidden in the statement. Therefore, they must be disclosed in a supplement schedule at the end. At the end, we have to show this. This is the income tax paid, this is the interest paid, because it is not shown in the statement properly. It is hidden. It is there, but it is hidden. Okay. Reconciliation of net income to net cash flow from operating activity. Reconciliation of net income to net cash flow means it's an indirect method. But if you're using a direct method, you must show separately. You can either show direct method or indirect method, no problem. If you're showing a direct method, you have to show this separately. Okay. But if you're using the indirect method, it can build either direct of the financial statement or provide separately. It's already there. It can build in the statement of cash flow only. Okay. So that's it with the statement of cash flow. Clear? Any doubts on the statement of cash flow? So we just understand what are the inflow and outflow in investing activity, inflow and outflow in financing activity. So this is how actual question look like. See, you have given what? Income statement. A balance sheet is given. 2 years balance sheet. Year 6 and year 5. And you have few information here. Okay. Based on this, you have to create operating activity, investing activity, and financing activity. It's not that complicated as it looks. First thing what I'll do is beginning cash and ending cash. Easy as that. So then I'll know how much is the change. So what was my beginning cash? 1 lakh. What was my ending cash? 95. So how much is the change? So it should be 95,000. From all the activities, 95,000 should be the answer. I mean, the net increase in cash is 95,000. Suppose in the exam, if they ask this simple question, you can ignore rest. You can write 95,000 done. So the net cash increasing from all the 3 activities, 95,000. That's it. Now we have a lot of adjustments here. So cash dividend of 2 lakh 40,000 were declared and paid by DICE in year 6. So they paid a cash dividend of how much? 2,40,000. One information is there. We paid 2,40,000. What activity is this? Financing activity. An account receivable balance at the end, balance at the beginning and the end of year 6 where net allowance for credit loss was 50,000 and 60,000 respectively. Desire wrote of 40,000 of account receivable during year 6. This information we can use in operating activity. Why? Because account receivable change we have to use. Current investment consists of treasury bill maturing on June 30, 2007. I mean 2006, now we want 2007, which means more 6 months. They get acquired for cash on December 31st, year 6. Okay. Might be they're telling they are trying to communicate this as a cash. They invested this. So what activity is this? Investment. Equipment costing 4 lakh, having a carrying amount of 1,40,000. Sold on January 1, year 6 for 1,50,000. What activity? Investing. Because we sold for 1,50,000, right? And also, it also communicate one more thing. How much loss or profit we made? 1,40,000 was the carrying amount, but we sold for 1,50,000. So how much profit we made? I mean gain. We made a gain of 10,000. So this would have affected your net income. So you have to minus from the net income. Okay. DICE account for its interest thrice corporation under equity method. Its equity in thrice year 6 was 25,000. Okay. During the year 6, DICE received 10,000 cash dividend from the thrice. At the end of the year 6, DICE sold part of its investment in thrice for 1,35,000. Significant influence over thrice was not lost as significant. Okay. 25,000 he earned through equity method. But 25,000 he earned means he earned income. In income statement we would have written. But the problem in equity method is this is not cash. So it is what? Non-cash income. So what you will do? Minus. You would have added here will minus. But cash dividend you will add. Cash dividend is a part of operating activity. And 1,35,000 for 1,35,000 he sold his investment. So it is investing and also it is operating activity, both. Provision for year 6 income tax was 2,10,000. They created 2,10,000 as a income tax. 10,000 shares of common stock were issued. What activity is this? Financing. This is operating because income tax is there. Okay. The following computation are necessary. Now we have to prepare operating, investing and financing activity. First we'll prepare operating activity. Okay. First thing in an operating activity, start from where? Net income. But anywhere we do have information of net income in this. What we learned, I read, right? Anywhere I have read regarding net income, you can't find net income on the balance sheet. But before we going to a break, we by using the retained earnings, we found the net income, right? Same method we have to do. Where is the retained earnings? Here. Oh, beginning was 1,70,000, ending is 620. Profit I don't know, but I know the dividend. What is the dividend I paid? 2,40,000. Use this and try. 4 lakh. Okay. What is my ending retained earnings? 6 lakh 20. Ending is equal to beginning. What was my beginning? Okay, it was 2 lakh 40 is the retained earnings, right? 1 lakh 1,70,000 plus profit. I don't know the profit, minus dividend. What is my dividend? 24, not 2 lakh 40. Yeah, 24. 2 lakh 40,000. Okay. So now what is the answer? Six lakh 90. Got everyone? So 690. I'll start from net income. So my net income is 6 lakh 90. Okay. Now next we understood that anything which is not related, we'll do indirect method, not direct method, because with this information we can't do direct method, because for direct method we want income statement. For with this we can do indirect method. Okay, we can do direct also, it is more complicated. IMA told us to prepare indirect method, we'll prepare indirect method, we'll understand this. Direct method you will be asked with the MCQs, easier manner, eliminate non-cash transaction, all this, take only which is related to operating and prepare. First thing here, what we learned is non-cash items, non-cash expenses, non-cash income we have to ignore, non-cash items we have to ignore. So in that, first we'll see this account receivable. Account receivable, we have recorded few expenses, correct? In this account receivable, we have recorded an expense. We tell credit loss 50,000, they wrote off 40,000 and everything. So by using this, how bad debt is what? Expense. It's a cash expense or non-cash? Non-cash expense, right? So that expense would have impacted your net income. Yes. So that you would have minus. Now you have to add back. So how much you have to add back is, so the credit loss, the net credit loss was how much we have recorded. Allowance for credit loss was created 50,000 and 60,000. So how much we have created? 50,000 and 60,000 and wrote off 40,000 in an account. So the easiest way to determine this is, we'll take account receivable. We'll do this one. Account receivable minus allowance for credit loss, which means gross account receivable minus allowance for credit loss is equal to net account receivable. Okay, so net account receivables are, you're able to see this here. How much is my net account receivable? 480 and 510. Okay, now we have to find this allowance, that is the expense, how much we have increased. So what was my allowance for 50 and now it is how much? 60. See, allowance for credit loss is a contra asset account. It reduces your asset value. Initially we were reducing by 10. Now we have changed to, like initially we were reducing by 50. Now we changed to 60. We'll learn this more in account receivable topic. We'll create a T account and we do this. Now, what was my gross receivable? Initially my net receivable was how much? Net is how much? 510. And allowance for how much? 50. Then my gross was how much? 5,60,000. So my gross was 5,60,000. Now we'll come this side. Now what is my net? And what is my previous net? What was my previous net? From this year to last year, how much it was? 30,000. From this year to last year, my net was how much? Like difference, I'm asking. This is a difference, right? So this we have to add in the income statement. One thing, and here we are writing off 40,000, right? We are writing off how much? 40,000. So the write-off means initially it was 50. I would have minus how much? 40. Write-off means we'll remove it from, and my ending is how much now? 60. Now 50 minus 40 is how much? 50. 10. And from 10, if you want to come to 60,000, how much you have to add back? 50,000 you have to add back. So that is what here we have to create. So now my 60,000. So what would be my gross? Try to calculate this. Five lakh. So what is the difference now we have? 5 lakh 40. Account receivable minus allowance, you have net account receivables, or a decrease in net account receivable was how much? Our account receivable got decreased 30,000. Okay, and added to that. Okay. Allowance for credit loss. Decrease in account receivable was 30,000. That we can report it directly, no problem. 30,000. Now my account receivable was how much? Where it is? Okay. My old account receivable was how much? 5 lakh 10. New is how much? 4 lakh 80. So my account receivable increased or decreased?
Sorry,
Decreased. So if it is decreased, what I can do? I mean, if it is decreased, you have to add back or you have to minus? Asset. Asset increase and asset decrease we had. Asset increase means what you would have done? You would have invested more. If you would have invested more, the cash went out outside. Now here asset decrease, which means you would have received cash, which means 30. So increase in account receivable is how much? 30,000. Okay, this one way. Increase in account receivable sorted. I mean, not increase. Decrease in account receivable is it create 30,000. Then we can write it. Just comparing last year to this year, my account receivable got decreased, so I have to add in net income. Okay. Next. Okay, this one is sorted, so I'll mark this. Cash is sorted, account receivable is sorted. Next we have in any depreciation we did. Yes, we did depreciation also, right? Where is depreciation? We'll look this where we did a depreciation. Here we have a depreciation information. Okay, so read this once. Equipment. Okay,
was sold for 1 lakh.
sold for 1,50,000. So my accumulated depreciation till date was 4 lakh. Say equipment costing 4 lakh and having a carrying amount of 1,40,000.
What do you mean by carrying?
Book value after minusing the accumulated depreciation. So what was my like depreciation? Equipment costing 4 lakh had a carrying amount of 1,40,000, means our accumulated depreciation was 2,60,000. Okay. We'll keep that aside and we have to check only this year depreciation. Do we have information related to accumulated depreciation anywhere?
Yeah, below that.
Where? Here it is. That's it. So my beginning accumulated depreciation was 450. Okay. So we'll do this. So 4,50,000 is my beginning. Beginning is 4,50,000. And what was my ending? 4,80,000. Okay. And this was my beginning and this was my, and an accumulated depreciation on item sold. We sold one item, right? On that, how much was the accumulated depreciation on this particular item? 2 lakh 260. 2 lakh 60. See, whenever I sell an item, right, my accumulated depreciation will go down. It is like when I have an item, what I'll do, I'm calculating a depreciation expense and I'm adding this to the accumulated depreciation. What does it do? It try to reduce my asset value. When I sell this, what I'm removing the asset, and also I have to remove my accumulated depreciation also. So I'll remove this. So now after doing, what is my depreciation expense? You check. 4,80,000 accumulated depreciation on items sold is 2,60,000.
So the accumulated depreciation which we sold, we need to add into the ending balance.
Which one?
2,60,000.
2,60,000?
Should be added to 4,80,000.
4,50,000, right? This one. Beginning balance is 450. We have to add it in a 480 because my beginning balance was how much? 4,50,000. Okay.
But usually, this is a formula, but usually we need to add to the beginning balance, right?
Beginning balance. See, accumulated depreciation, assume that this is a ledger. Okay. Accumulated depreciation, whenever we charge a depreciation, what is a double entry is depreciation expense to accumulated depreciation. Depreciation expense to accumulated depreciation, and in my BCom or in my +2 we were doing directly depreciation expense to plant machine, direct. But here in US GAAP we have to first transfer into accumulated depreciation, then only we have to write off. So each year when I was doing this, what happened? Depreciation expense to accumulated depreciation, which means here by depreciation expense I'll write. It was on the credit side. So how much it is? Example, I were writing here 4, and my beginning balance will come here. So my beginning balance was how much? 4,50,000. Whenever I charge the depreciation expense, I will write here only. How much it is? This year it was 290, and we don't know this. Consider we don't know. Okay. Whenever I sell, it will go opposite side because I'm removing that accumulated depreciation. So I removed it. Now what is my ending balance? 4,80,000. So when to be a 4,80,000, so 4,80,000 plus 2,60,000, because here we'll carry down or we'll tell, right? Brought down is how much? This one. Okay. If I it says the ending balance is 4,80,000. That means 4,80,000. Here also it will be 4,80,000. Then 2,60,000 will be the depreciation expense. Oh, sorry. 2,90,000 will be the depreciation. So this depreciation expense I know. So it's a cash or non-cash. So I have to, how much it is? 2,90,000. Clear? No, 2,90,000 is this year depreciation expense. Accumulated depreciation is a balance sheet item. Depreciation expense is an income statement item. So accumulated depreciation for this year is 4,80,000. Clear? And one more thing also we did here, we sold an asset, right? We sold an asset and it was on a gain. What was the gain we incurred? 10,000. 1,40,000 was the book value, but we sold for 150. So we earned how much? 10,000. So we have to minus that. Gain on sale of asset, how much? 10%. Okay. Anything left? Gain on sale is done. Okay. Clear. This one is completely done. Which additional plant assets also purchased in year 6. They are telling we purchased asset, it seems. Okay, it will not come under operating activity, it will go in investing. But for how much we have purchased? Can you figure out? We can do that easy. See, my beginning asset was how much? My beginning asset was how much? I mean, 1 million. My ending asset is how much? 17,30,000. Doesn't mean that we purchase for 7 lakh. We purchase more than this because we are selling here. What was my equipment costing? 4 lakh, right? So I had an asset of 10 lakh. Okay, I had an asset of 10 lakh and I sold 4 lakh worth of asset. So I have only 6 lakh. But today I am telling I have 17 lakh worth of asset. Then how much I would have purchased? 11,30,000. Exactly. So we purchased for 11,30,000. It's a cash outflow. So I will create that separately. Investing activity. Asset purchase outflow. How much it is? Because in the 10 lakh, we have to minus first 4 lakh, the asset we bought. Then we have ending balance. So now how from 6 lakh it went to 17 lakh? Because we would have purchased for 11 lakh. Done. This figure is completely done. And the dividend we can directly write, right? 2,40,000. Where you can write this one? Financing activity. Outflow, right? Dividend outflow 2,40,000. Okay, done. This is also done. This is also done. Next, we have investment. Okay, investment. We have two investments. We have here there is one investment and there another investment. Here they are telling it is there in the equity method. Okay, first we'll clear this. Dice account for interest in thrice company under the equity method, and first carrying amount of the equity was how much now? Now current investment we have for 3 lakh. We have investment for how much? 3 lakh. This is current investments consist of treasury bill maturing that was acquired on cash. So we have an investment for 3 lakh. Okay. And also equity in thrice current earning is 25,000. Dividend received, we received dividend for how much? 10,000. Ending carrying amount is how much? 2,15,000. This one. This both are investments. Okay, clear. So I had an investment for how much? Initial 3 lakh. Now what is my ending? Okay, this is my ending. I had 3 lakh of worth of investment. Now I have only 2,15,000 worth of investment. And also this is an equity method. In equity method, whenever they pay dividend, right, they are paying from my investment. They are paying from my investment. So how much they will pay from my investment? 10,000. They are paying an investment 10,000 because they are giving an dividend from the investment. See, equity method is I invested in your company for 1 lakh and your company made 1 lakh of profit and I have 30% of ownership, which means from the 1 lakh profit I'll get how much? 30,000. But if you check for the cash, no, I have not received the cash, but I got 30,000, that much I'll tell. And when I pay dividend, when I get 30,000, I'll add. When I pay dividend means I'll remove from the investment and I'll get the cash. So exactly how much they gave from my investment? They gave from my investment 10,000 they gave. And also they say Wait. They gave 25,000 also. They gave 25,000. So if I rewrite this, my ending balance, investment. My ending balance is how much? 2,15,000, which means beginning balance plus they gave me how much? 25,000, and they gave a cash of, from this I took a cash of 10,000, and what is my ending? 2,15,000. So how much more I would have invested? So I have invested, no, I would have withdrawn from this. So I would have withdrawn 1 lakh. But this 1 lakh investment I sold for how much? 1,35,000, which means 35,000 gain. Okay, 135,000 gain. First we'll write this 1,35,000. Where you will write this 1,35,000? Investing activity. Because from the investing activity I'll got direct 1,35,000. And next, where you have to subtract this gain? Gain on sale of investment, 35,000. Because the 1 lakh asset we would have sold for 1,35,000. Then in the net income we would have recorded I earned 35. But this is not related to operating activity. This was related to investing activity. So I have written 135. And also 10,000 I received a dividend, right? From this particular investment. So that dividend we can record in the operating activity. Dividend received. Dividend paid is financing activity, which we have recorded. Dividend received is operating activity. So 290, gain on sale of equipment minus 10,000, gain on sale of investment 35,000. Okay. Next, what we have done, this one is done. Provision for income tax, common share. Okay, we'll now this is done. This is done. Inventory, what happened? Increased or decreased? Increased, which means minus 60,000, 80,000. Next, prepaid expense, 20,000 to 15,000. Decrease, which means we have to add prepaid expense. We have to add 5,000. Okay. Anything left? No. One more. Goodwill and investments are left. Goodwill is how much? We had a goodwill of 1 lakh. Now the goodwill value is 90,000. That means I had an intangible asset of 1 lakh, and the intangible, we would have done amortization. Goodwill is not done amortization. Goodwill is done impairment, which is also loss. Loss, where you would have recorded? Income statement. But is this a cash loss or non-cash loss? Non-cash loss. So which means you have to add back, which means goodwill, you will add back how much it is? 10,000. Now we left with current investment. We didn't have an investment of 3 lakh. Now we have purchasing this investment. I mean, we are purchasing investments, inflow or outflow? Which activity? Investing activity. How much it will go outflow? 3 lakh. Okay. Done with this. Now we'll go to the payable part. What happened to my accounts payable? Payable increase means inflow or outflow? I mean, we have to add in operating activity or reduce in operating activity? Add, because payable increase means we would have not paid. If you would have not paid, my cash wouldn't have went out. So I have to increase by how much? 105, right? So add payables 1,05,000. Okay. Next, interest payable. What happened to interest payable? Increase. Okay. How much it got increased? 5,000 increase, right? Initially I was about to pay 10,000. Now I have to pay sorry, interest. So I have to pay 15. So increase means I have paid. Add or minus? No. Payable increase means add plus 5,000. Then next, income tax payable. Initially it was 30. Now it is how much? 20. Which means I have paid more 10,000. So how much I would have, what I have to do? Minus 10, right? Next, current debt. Initially I didn't had any loan. Now I have a loan of 3,25,000. Which means what? Inflow or outflow?
Now we don't have any cash because it's a debt.
Debt. See, last year I didn't had a debt. This year I am having a debt 3,25,000 suddenly. Which means I have taken loan or I have settled the loan. I have taken loan means inflow or outflow. So it will go in financing activity 325. Okay. Then next, deferred tax was actually 3 lakh. It is a liability. Okay. Now it is 2,50,000. I had a liability of 3 lakh. Now I have a liability of 2,50,000, which means I paid a liability, right? Which will reduce the cash. So I have to minus deferred tax liability minus 50,000. See, deferred tax is something, a tax which I postponed. Like this, I postponed and kept 3 lakh. Now from the 3 lakh, now it is 250 means I paid 50. Whatever I postponed, I paid 50 means from the operating cash flow, I have to pay 50. Clear? Deferred tax is done, income tax payable is done, interest payable is done. Okay. Next, common stock. We'll come to common stock. My common stock was 7 lakh earlier. Now it is 8 lakh, which means increased by 1 lakh. Okay. Now, additional paid in capital, what happened? From 250 to 370. Increased by how much? 120. So total I issued for how much? My new share. Because when I issue for a share, by issuing a common stock, I raised 2,20,000. So I'll write it here. 2,20,000. Okay. Next, retained earnings, we already did adjustment. This is also done. Current investment, I think we outflow 3 lakh went, right? Outflow 3 lakh went, and we got 1,35,000 from the sale of some plant, and no, we have not added that sale. See, I sold an equipment and I got how much? 1,50,000, but it's the investing activity, right? Inflow or outflow? Inflow. So I got this. Investing is done. Financing 240 dividend, 325 I took a debt, and this one I raised equity. This is sorted. Now add all this. I mean, add this investing and financing activity. How much you will get? $285, 250. Which one? 11 lakh. Oh, it's outflow. 11,45,000. This one?
Three lakh.
3 lakh. Okay. plus. See, after everything, after 3 activities, it should be 95,000, right? From cash beginning and ending. No, I don't want to invest all this time calculating operating, because operating was tougher. If I would have, if I know what is ending and I know investing and financing activity, my operating activity, without doing all this, I can get in a line. Correct. Without preparing only, I can. So this is the trick which you can use to get the answer directly. But obviously, suppose if they are asking particularly, not giving other information and only giving this information, try to do, then we have to do. Suppose if they are giving an entire story and telling to find operating, you know what is the cash balance you want, you know from investing how much you want, financing how much you got, you know, then you'll automatically know how much you would have got from the, obviously it will be plus, because 305 is plus, 1,145 is in minus, obviously this will be plus. I think one thing we missed, I think so, this part, where this, okay, this equity method is little bit confusing. Yeah, we'll discuss this again. Desire accounts for its interest, thrice corporation and the equity method. We have an investment in some other company. The equity in thrice year 6 earning was 25,000. How much I earned? 25,000, which we know that it's a non-cash expense. Sorry, non-cash income. So what we adjusted that 25 somewhere. Have we reduced somewhere 25? No, we have not reduced it. I mean, this 25,000 is an income. We would have recorded in the income statement as what? Income received. But have we received this 25,000? No. But we actually received how much? Only 10. So net, how much we have not received and we have recorded? 15,000 we would have recorded more. So here what we have to do? Minus 15. Equity method investment 15. Either I can write 25 minus and add a dividend 10 also you can do, or I can, that is the reason I have not written dividend anywhere. Now first what we'll do, we'll find what is in the operating activity you want from the reverse. I want 95,000, right? 95 plus 305 minus 1,145. Sorry, minus into minus, like $305 plus 95 plus 1,145 . And also I had a beginning cash. How much I had? 1 lakh. So my ending is 1,95,000. So how much you got operating by doing reverse method? 305, and this is in minus, and I have 195 in cash. $935. See, do one thing, do minus from 1,145 minus 305 and minus 95, which means 4 lakh. Okay, and also we'll try to calculate each number. So net income 690, decrease in receivable, add, depreciation expense, add, gain on sale, minus, gain on sale of investment, minus, inventory increased 80,000 minus, prepaid add 5, goodwill add 10, and 1,05,000, 5,000, 75, 935 you will have. Okay, at last if you calculate all this you will get 935,000. So 935 plus, I mean plus means in the minus it will be minus 1,145,000 minus 210 minus 210 plus 305 is equal to 95. Okay, clear? Any doubts still here? So a lot of calculation, a lot of things we'll study, like example the asset part, right? Once again we'll study this asset part. Once again we'll understand equity method. So then you will understand why we are doing this. See, equity method, I told it is not considered as an income because we do have other methods too. Then you will understand why, because here in equity method you earned but not received cash. If you earned, where you would have reported income statement, but have you received cash? No. So minus, it's a non-cash income. And depreciation expense, we use accumulated depreciation and all those things. Next we add about account receivable. Okay, so we'll take this where you see here 935. See, first income sorted, then account receivable add, depreciation expense add, gain on disposal of equipment minus 10,000.
And the class gets okay, just okay, the orientation.
Gain on disposal of equipment minus 10,000. Gain on sale of investment. I told, right, gain you would have added there, but here you have to minus it. Next, undistributed earning on equity method. Here they have written net. I told that 25,000 I have to minus, but they have added the 10,000 dividend net. Loss and impairment of goodwill. Goodwill value decreased, but is the cash went out? No. Increase in inventory, decrease in prepaid expense, because asset decrease, you have to increase the cash. Increase in payable, increase in interest payable, liability increase, you increase. Decrease in income tax payable, yes, you have to decrease here because liability decrease minus. Decrease in deferred tax, liability decrease. So simple as asset increase minus, asset decrease plus, liability increase plus, liability decrease minus. Liability is a positively correlated, asset is negative. If asset increase, I'll minus. If asset decrease, plus. Then proceed from the sale of equipment. I sold one equipment for 1,50,000. I purchased for 11,30,000. That also we have not found directly. We took the beginning balance, minus the sale, and by putting the ending balance, we got the purchase. Proceed from the sale of equity method. I sold some equity investment for 1,35,000. Current investment I invested in 3 lakh. Done. Next, dividend paid, issued common stock, issued debt. Okay, that's it with your statement of cash flow. We covered statement of cash flow. I'll send these notes to you. By today you'll get these notes. Tomorrow, I mean in next class, there is one small theory topic called integrated reporting. We'll do that and we'll start doing current asset. In here we mostly learn theory, not practical. This, it's all rules, right? Where you report. Next also is the rules, but it has practicals. Till last it will be a practical. I mean till revenue recognition, now it's going to be practical after integrated reporting. Okay, any doubts still here? If you can do one thing, you can take this picture, if you're able to take the picture, right, and try to do once again, and whichever you find a problem, we'll discuss again. Okay. will be perfect. Or you can find in the video also. Any doubts still here? Cash flow statement, like I mean, all the financial statement is done. Now we're pending with in financial reporting. We are pending with on a theory topic, integrated reporting, complete theory. We can tell like it takes 1 hour session is enough for integrated reporting. Then we'll start with receivables, payables, assets, and everything. Okay. Cash flow statement practice once again. Go through the notes. Lot of rules are there. How amortization of discount, those things, indirect method, direct method. Once you understand, then once you start doing MCQ, right, you don't worry about indirect and direct method. In MCQ, they will ask any one item. Tell me what is this, tell me what is this item. That's it. Okay, thank you.
Hi guys, if you're doing CA, CS or CMA, you need to check out ArivuPro app. This app offers you recorded classes, study material, chart notes, test series, and much more. The best news is, all these things are provided at just 1,250 rupees. Check it out.